That in a moment. 130 on the pound, up by around 0.2%. It went through that level before we got some of the data today, but then the fact the data was better than expected on GDP, perhaps reasserting that 130 level. The Bloomberg dollar index is weaker, was weaker yesterday. That theme continues. We saw, as a result of the weakness in that CPI print, then we saw the dollar coming off. We also saw buying of bonds, yields coming down. We continue to see a bit of movement at the 10-year, but 3.83 is a lot weaker than we were in terms of where that yield is. And Brent in focus because, of course, of the demand story, the supply story, and the dollar story. What do you see on futures then, Stephen?
Treading water at the moment, heading into the open, and of course European shares had rallied sharply on that softer CPI print yesterday as well. We've seen the futures flip between gains and losses. We're looking at perhaps Germany and France pointing higher, FTSE though pointing lower as we head into the start of today's trading.
Okay, so we could see quite a lot of divergence then at the start of trade, which would be interesting for European equity markets. The London market then flat at the start of trade, focusing in, whilst we wait for these European equity markets to open up, focusing in on some of the moves we've got on FX. This is still the focus, really. Weakness in the dollar. Just how much more hiking will we get from the Fed? Will it only be 25 basis points in July? And then what happens to the other, to the rest of the year? Will we be back to pricing in cuts soon? Or how will that narrative develop? We'll have to watch the data. But certainly that's the questioning that's been put in place as a result of that CPI print yesterday. The other side of that weak dollar then is strength in other things, and the euro and the pound both go higher. The pound influenced by its own domestic factors, but yesterday very much by that US CPI print. So here we've got the French market up by 0.2%. The FTSE is flat. The Spanish IBEX up by 0.1%. A bit of M&A in the French market, perhaps. We were discussing that with Joe Easton. Perhaps that's having an impact there on some outsized moves. In terms of the commodities space, interesting to watch how these commodities have been reacting to perhaps coming to the end of the hiking cycle in the United States. Does that leave room for growth and demand in terms of commodities? But then on the other hand, it weighs on the dollar, which also pushes prices higher. So there's a lot going on when it comes to the commodities markets as well. Stephen, what do you see a minute or two into the start of the trading day? What do you see on the sectors picture?
So it's a pretty mixed picture, actually, if we're looking at the sectors that are moving this morning. Very anemic start to the start of trading here in Europe, but as we say, holding on to those gains from yesterday. I'm drawn to basic resources because part of that currency story, very interesting there. I mean, if we're looking at the weaker dollar as well, what does that mean for the currencies picture? We also had that latest Chinese trade data as well. So basic resources up by 0.3%. Technology shares continuing to gain as well. We had some more positive signals in technology front out of China, of course, boosting tech shares there. So perhaps some of the read across feeding into the technology part of the index being up by 0.5% this morning. Construction shares up by 0.7. That's interesting given the UK house price picture that we've got more survey out from RICS, actually not painting a very positive picture about the UK housing market. We had results too from Barrett feeding into that too. Some of the weaker sectors, industrials, banks down 0.3%, travel and leisure shares a little bit weaker there as well. So mixed picture, but mainly, as we say, holding on to those gains that we got yesterday.
Yeah, holding on to some of those gains, a bit of a mixed picture then. A day after we saw really strong gains for European equity markets. Let's get more now with Sophia Holter-Acosta from our Markets Today blog. And in terms of risk sentiment, Sophia, we're in an interesting place because the movement of yesterday has gone through into the Asia session, and we see strength there through the Asian equity session. There's the CPI story, but other factors being pulled in there. US futures point a little higher, but we're kind of a little static here in Europe, looking for the next catalyst, maybe.
Exactly, and it's also kind of a very difficult narrative to read in the UK. I mean, the economy here is better than expected, but it's also weaker. You know, you have the positive story out of the US, but the negative story out of China. But within China, there's also kind of, is bad news good news, because that means more stimulus. So a very difficult market to trade right now, looking for more catalysts, but also looking for more clarity. Is the inflation picture in the US really turning? Is China actually going to deploy stimulus? Is the UK economy more resilient than thought? There's so many questions in the market right now. I think the majority of the action is really in FX, and people are looking at dollar crosses, how to play that story. It's perhaps the clearest story to play right now. Dollar weakness, which will be the biggest beneficiaries of that. Here in markets today, on the blog, we're so obsessed with the 1.3 handle, so seeing if the pound can really break through that. It did break through it yesterday, but really struggling. That seems to be kind of a land in this line, sorry, not a land, a line in the sand for the currency here, really kind of battling between interest rates and eco data.
One of the parts, of course, of the UK market we're watching very closely is the property story, because it's sort of unfolding slowly day by day, the negative sentiment coming from various different sources. This time we've had an update from RICS showing a pullback there in what buyers and sellers are doing.
Yes, exactly. And sellers are really kind of pulling out from the market, because why would you sell in this market when there's so many negative headlines, interest rates really kind of weighing on sentiment, buyer sentiment? It's not a seller's market. So the supply and demand kind of dynamic in the UK is really interesting. Let's see if that feeds into prices, though, because there was an expectation that this would mean prices would fall a lot more than they have done so far. So the anecdotal evidence is that sentiment is weak, and this kind of, the data today really reinforces that picture. But actually, if you look at the hard data, it's not as weak as expected. So is there a lag in the data? Again, more questions around that. Housing is kind of everyone's obsession here in the UK as well. So we'll look at whether those kind of interest rate dynamics would feed into the hard data.
Yeah, I mean, those who don't have to sell, maybe not selling, and that reduces supply and reduces the sort of the way that price responds to the demand picture. But of course, maybe we will see more forced selling. We talked about buy-to-let landlords yesterday, didn't we? Perhaps that'll be a dynamic to watch.
Yeah, absolutely. And look, we're seeing this reflected also in the trading of some of those construction companies on UK markets today, weaker across several of the parts of that sector as well. So that is an interesting other element to that story. Sophia Horty-Acosta from Markets Today blog, thank you so much for joining us with the latest on those stories. More from Sophia and the team on the front page of the Bloomberg UK website, or by typing TLive on the terminal as well. Well, let's get a check on some of the individual stocks on the move with Joe Easton. Joe.
Absolutely. So we're going to start with watches. Watches of Switzerland jumping almost 9% here in the UK. The management very upbeat, including in our interview on the show earlier. Meanwhile, Swatch hasn't opened yet. That's the luxury space. I am seeing it called higher in indicative pricing. We do expect that one to rise over in Switzerland. We're going to check in too on chemicals. Now, these ones, they are actually rising in early trading. BASF at least was up when I was at my desk. It's now come down a little bit, but not much of a reaction to that profit warning. A lot of that priced in following warnings from Lanxess and Croda, and we're not seeing a huge reaction there. Analysts saw that one coming a mile off. We're also going to look at a couple of analyst ratings that are jumping out this morning. We've got an upgrade for Schroders in the UK over at Barclays. They prefer Schroders to the French company Amundi. That's in the asset management space. Meanwhile, NatWest gets only one of 3 sell ratings. This is at Mediobanca. They're worried about the impact of rising interest rates. Barratt Developments, the worst performer on the UK main market today. That's after both a trading update warning of a 49% drop in sales and also that weak RICS pricing data that you were discussing a moment ago. That's weighing on all the home builders, those ones underperforming today.
Joe, thanks very much. Joe Easton from our equities team. Thanks for the update. Let's get a rundown of the things we're watching out for today. At 9 a.m, we get the IEA's monthly oil report. Then at 11 a.m, we get the UK's OBR report on the fiscal risks facing the United Kingdom, with a press conference expected half an hour later. At 1:30 p.m, we get US PPI and jobless claims. And finally, in the evening, the French President Emmanuel Macron hosts the Indian Prime Minister Narendra Modi at a dinner in Paris. So from the UK perspective, clearly the OBR conversation will be interesting. The focus reportedly set to be on the reduced fiscal space that the government perhaps has. So public pay sector will be listening to that. US PPI, though, from the data perspective, after the CPI print of yesterday, that's going to really be in focus. We are expecting all of the measures of PPI to step back from the levels we saw last month.
Yeah, well, it adds to that sentiment that we're seeing on markets today, reacting to the softer numbers today as well. Will that add on to PPI? A word on that Narendra Modi and Emmanuel Macron meeting, though, as well. Defence very much in focus. We were reporting earlier in the week that there is a deal that India is going to be buying more more Dassault jets, the Rafales. This is a huge political issue in France. There's been deals dating back over a decade that came through, didn't come through, coming through in piecemeal. So an evolving part of that defence story to watch from that meeting happening in Paris.
Okay, so some geopolitical theatre to look out for there. Still to come on the programme.
Yes, coming up, US CPI in focus next. Our next guest thinks we're only halfway there when it comes to normalising inflation. More on that story next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
This is Bloomberg.
The moment news breaks, no one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI semi sort of trade here.
The $69 billion deal is the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
This was a good report.
An extraordinarily good print for the Fed.
The Fed should be pretty cheered by this.
Disinflation is starting to take hold.
But I don't think it changes what they're going to do at the July meeting.
I don't think it changes the move in July from the Fed.
I think the Fed will hike in July.
They can't take their foot off the pedal yet.
Could July be the last one?
If this is the new run rate, then yes, it would call into question hikes beyond July.
They won't move at the meeting after July. They'll take a break just like they did this last time.
That September hike is one where, they can afford to skip again, given the way inflation's sort of behaving right now.
And then we're going to get to November 1st. Well, there's a long time between now and November 1st.
There's a lot of time between now and November.
The November rate hike is really up for grabs at this point.
Bloomberg TV guests reacting there to the sharp cooling off of the US inflation rate. Some see November as the most likely turning point for the Fed, with the majority predicting another hike still to come in July, though, before, of course, we get to November. Just breaking away from the macro for a moment, just to revisit one of the stories Joe Easton was talking about earlier on. Swatch share prices now open, and we see that it has jumped 5.5%. The stock rallying then as the Swiss watchmakers' first half earnings exceeded pre-pandemic levels for the first time as China's reopening reopening is really starting to fuel a rebound here. And so this is in good company this morning. The Swatch share price moving higher as Watches of Switzerland also moving higher. We spoke to the CEO a moment ago, didn't we?
We did, but we'll leave watches aside for one moment and turn aside to the bigger picture facing markets now. We've got Michael Metcalf, Head of Macro Strategy at State Street Global Markets, with us in studio. Morning to you, Michael. So, softer CPI, we're looking ahead towards PPI later, but you say we're only halfway there when it comes to normalising of inflation.
Yeah, I mean, look, so the June print on its own was great news. You know, we're used to core inflation being between 0.1 and 0.2 on a monthly basis. That was the pre-pandemic average. You know, June was 15 basis points, so right in the middle, which is great news. I think the thing that we're concerned about, though, or just one point of caution, is that this is just 1 month. The quarterly run rate of core inflation is still above 4, and it needs to have a 3 handle at the very least before we can start to relax. And I think there are, you know, if you look at things like median CPI yesterday, that was 0.3. There are a few special factors that dragged core inflation down. So I think good news, but not quite good enough yet.
Are you thinking about the risk then of an uptick in inflation and what that does to the conversation, that we tick up again, or does it keep falling from here? Well, because you say we're only halfway there, but I mean, 3, you know, in terms of sentiment, 3 feels a 3-handle headline feels incredible.
Well, it says a lot about where expectations have come from, doesn't it? That we're happy with 3. I think that could it tick up again, to your question? The one thing that we know for sure is that rents are going to start to come down, so that will weigh. But I think one thing just to be wary of is that you know, there were a few, so you know, hotels and airfares in particular, and that's why that dragged the core CPI rate down. So in the PPI report today, really important to look at airfares because that's what feeds into the PCE report that the Fed targets.
Okay, so that's an interesting one as well. Do you feel the market reaction was overdone then yesterday when we looked at the movements in the dollar, for example?
Well, not necessarily. I mean, I think 2-year yields had gone up an awful lot. And you know, I think we've been waiting for the dollar to fall for quite a while. So perhaps you know, not too surprising that when you finally get a miss on CPI, that you get the reaction that you've had. I think I'd just be careful about extrapolating.
Okay. In terms of the the picture you're seeing in the data in the United States, I was drawn to this chart supplied by Bloomberg Economics, which, I mean, there's a lot going on in this chart, but really what you need to focus on is the far right-hand side, and it shows that the blue line, which is rail freight carloads, really dropping. I mean, there are other forward indicators in here as well. I don't know which forward indicators you choose to look at, Michael, whether it's this or it's other things, but that looks quite startling, that drop-off there. What are you seeing in the sort of forward-looking data?
Well, I can tell you that our own recession likelihood index, which basically looks at patterns of industrial production, employment growth, equity markets, and the yield curve, is still predicting more than a 50% chance of recession. And so, you know, even though we're now talking, and you know, I think yesterday's data, we got a glimpse of the runway for a soft landing. Most leading indicators are still pointing to the probability, a high probability of recession. You know, we haven't gotten away from that yet, and certainly one soft CPI print isn't going to change that anytime soon.
What does that mean for the outlook for equity markets then for the rest of the year? Because a very good first half, with Madison Fowler from JP Morgan Private Bank telling us yesterday that gives us the likelihood of a good second half as well.
Well, I think the thing that we'd be concerned about is, you know, looking at what institutional investors have been doing so far this year. So their allocation to equity has gone up, but all of that is price effect. And actually, if anything, investors look like they've been fighting against it a little bit and actually trying to reduce risk. And so I think if recession risks are finally realized, it's not clear to us that equity markets have fully discounted that yet. So, you know, actually, I think we'd be a little bit, we think bonds are probably a bit safer, especially after the CPI number yesterday.
Can I ask you about Japan, Michael, and your thoughts there? Because for a long time, we've been looking for, you know, when are we going to get this move from the BOJ? When are they going to stop being quite such an outlier in terms of their monetary policy and look a little bit like the rest of the world? It doesn't seem to be coming anytime soon, although the market is increasingly speculating, and you can see that in the gains that we've seen in the yen since the beginning of July, speculating that we might get some tweaks around yield curve control. What do you see coming?
Well, so the one thing that we would just start by saying is that inflation is back in Japan. And so at some point, the BOJ does need to act. And I think that the difficulty with yield curve control, in contrast to other central banks who try and guide and not surprise markets, we know that the only thing that will happen when yield curve control is tweaked is that it'll be when it's least expected. And so I think because of that, every single BOJ meeting this year is live, and eventually they will tweak it. But when they will tweak it is
But you think sometime this year?
Oh, for sure, yeah.
Right.
Okay, a question on the UK as well. We had the economic data out this morning, so things not looking as bad as had been expected in June, a smaller contraction than expected. The inflation picture, though, is still extremely hot here. What's your outlook for where the Bank of England goes from here?
Well, interestingly, we have this online data, online inflation data in the UK, and that has been robust for much of the year, but June was different. June was much softer. In fact, it was the softest relative to seasonals since January, which actually was the last time the official data in the UK surprised on the downside. And so we've had this awful run, and you can understand why the Bank of England has had to do what it's done, because the upside surprises to UK inflation this year have been even worse than last year. But if the online data is a guide, June should be a bit better. So what happened to the dollar yesterday could happen to sterling around the UK inflation print, if that's right.
Because if you mentioned the month of June, we also got real weakness in the payrolls number for June. I was cautioned by Bloomberg Economics not to read too much into that one data. It's much revised, they said, but that was also an area of weakness in that payrolls report, even though higher wages got much of the headline for the month of May. Michael, thank you.
Michael Metcalf, head of macro strategy at State Street Global Markets. Coming up next, why are Goldman executives downplaying expectations ahead of the company's upcoming second quarter results? We'll bring you the story next. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Markets Today, 21 minutes into your European trading session. Things looking pretty mixed, flat for European equity markets, perhaps looking for another catalyst after we climbed very strongly as a result of the weakness in the CPI print and revised Fed expectations in yesterday's session. Let's get to some of the top stories on the terminal today. Walt Disney has extended the contract of the CEO, Bob Iger, for another 2 years. The company says Iger will remain in the top job until the end of 2026, giving him more time to implement his turnaround plan and find a successor. Iger returned to Disney in November after previously serving as CEO for 15 years. A review of thousands of pages of documents and emails suggests the relationship between convicted sex offender Jeffrey Epstein and former JP Morgan executive Jez Staley went far beyond that of banker and client. It points to regular contact between the two men, with Epstein allegedly helping Staley's daughter with her education and offering tips for negotiating his multi-million-dollar salary. A spokeswoman for JP Morgan told Bloomberg any association with Epstein was a mistake, and in hindsight, we regret it. But we did not help him to commit his heinous crimes. Staley has previously denied wrongdoing and knowledge of Epstein's crimes. A lawyer for Staley declined to comment on this latest report.
Advertising technology company Trade Desk is to replace Activision Blizzard in the NASDAQ 100. Earlier this week, a US federal judge said that Microsoft can move forward with its acquisition of the gaming company. Shares of Trade Desk have surged by 89% this year, helped partly by excitement over artificial intelligence. NASDAQ says the rebalancing will take place on Monday. And Elon Musk has announced the formation of what he's calling XAI. It comes after months of hints that he wants to build an alternative to the ChatGPT AI chatbot. Musk was involved in starting up OpenAI, the company behind ChatGPT, but has frequently criticized the firm since he left its board in 2018.
Goldman Sachs executives have been issuing rare earnings guidance, downplaying expectations ahead of their upcoming second quarter results. The move breaks with the company's own long-standing convention and comes after two successive earnings day disappointments. Here to talk us through some of the latest on this story, Bloomberg's JP Barnett. JP, good to have you with us. So what have Goldman Sachs executives been saying, and why have they felt they need to do it? I mean, this is what lots of other companies have been doing for many, many years, sort of setting expectations for earnings ahead of the day.
Yeah, that's very unusual for Goldman to do this either to the upside or to the downside, and especially to the downside here. And what we are hearing from the executives out of Goldman is not sounding very pretty. Among them is a hint that trading revenue will fall by 25%, that they take a material markdown in their real estate portfolio, and a hefty write-down as they're selling their Green Sky Landing platform, one of the missteps in the strategic realignment where they try to move into consumer business. So all of that is very unusual for Goldman, and it sounds very bleak for the upcoming earnings day.
So you talked us through some of the hints coming there. So what exactly are we expecting from Goldman earnings next week?
So the estimates from analysts have been slashed already by 50% since June. So the bar is materially lower now for Goldman to jump over. The question is like, will they manage to do this? Because the risky play here that they're doing is, and now that they have lowered the bar, the question is like, will it be enough? And if they fail again to jump over it, then we probably need a stronger word than just ugly describing their upcoming earnings day. Also, we want to see like how the overall business is going on. We still have the issue of banks like being in the spotlight after the March wobbles that we saw. So any color here will be much appreciated, I guess.
How have investors been reacting then, JP, so far to the fact that Goldman is out there trying to set expectations?
Yeah, so the stock price has been fairly stable, which is a little bit surprising to me. I guess like most investors have already had that in their playbook or their notebook to see like that Goldman has not done very well over the last couple of quarters, and there was very little so far in terms of market environment and overall color and what we're hearing from other banks to suggest that the environment is improving sustainably. So I guess like many investors like already expect that it won't be a pretty quarter. Now that the bar is lower again, as I said, like Goldman really needs to meet that lower expectation or jump over it, because otherwise, like we are looking at another -6% day probably.
Okay, Bloomberg's Jan-Patrick Barnard, thank you very much for joining us with the latest on that story on Goldman Sachs. I mean, look, it's an interesting kind of moment to see a shift in, Wall Street Titan and how they communicate and what they're telling markets as well. And that return on equity figure going to be a really interesting one to watch as well. Could slide below 5%.
Yes, absolutely. And they've been trying to convince the markets that they can sort of reduce the volatility of their earnings. And so we'll see how that plays out this time around. The retail banking pullback, of course, getting a lot of attention.
Yes, indeed. July 19th for those earnings. Coming up next, we'll discuss what we've learned from a busy NATO leaders summit and what it all means for Ukraine. That's next. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today, 30 minutes into your European trading day. Here are your top headlines. The risk-on mood continues in the European session as the slowdown in US inflation bolsters bets the Fed is near the end of raising rates. China's exports fall for a second straight month in June, adding to the economic pain that has hampered the nation's recovery. Plus, the pound pops as the UK economy shrinks less than expected in May, despite an additional holiday for the coronation of King Charles that weighed on activity. And Stephen, with the pound, difficult to untangle the domestic drivers from the international flow, so the CPI print out of the US, of course, affecting the dollar part of the cable trade. But in terms of the equity market performance, modest gains across Europe today.
Modest gains except in London, where we are seeing the FTSE 100 underperforming across the European picture as well. But as you say, we're holding on to the gains that we had yesterday when we look at where European indexes are at this point of the trading session. So Stock 600 up by 0.1%, the DAX up by almost 1/10 as well, and the FTSE 100, as I say, just dipping into the red there as well. If we look at the sectors, pretty even split across gainers and losses across the sectors today. Again, the overall message is that shares are hanging on to the gains that they had over the softer US CPI print. We're looking at gains the likes of technology, for example, up 0.8%, construction shares up 0.6 as well. That's an interesting story to be watching too. And if we're looking at the picture where things, I suppose, are a little bit weaker, banks down 0.3, industrial share companies down by 0.4% too. Now, a couple of companies that are in fact the best performing shares on the Stock 600 this morning are related to watches. Watches of Switzerland, we spoke to their CEO, Brian Duffy, a little bit earlier as well. Their results helping, certainly being well received by investors, up by 11.5%. The Watches of Switzerland results. Swatch also reporting better than expected earnings. That is helping to boost their share price up by 5.8% this morning, Anna.
Okay, let's turn to geopolitics then, Stephen. NATO has wrapped up a two-day summit in Vilnius, signalling Ukraine belongs in the alliance, but falling short of a clear timeline for getting it into the alliance. Despite initial tensions, President Zelensky thanked allies for their support and hailed G7 security guarantees for Kyiv. Meanwhile, President Biden, who is in Helsinki today, reiterated allied support will not waver.
I hope you all got a sense today from all of my colleagues that how much support you had. It's real, and I hope we finally have put to bed the notion about whether or not Ukraine is welcome in NATO. It's going to happen. You're all moving in the right direction. I think it's just a matter of getting by the next few months here.
President Biden speaking there. Let us get more from Bloomberg's Maria Tadeo. She's still in Vilnius, where the NATO summit has been taking place. Maria, was this summit a success then? Tell us from various perspectives, I suppose.
Yes, Anna, and it always is a very difficult question to answer. But if you look at the main goals of this summit, one was a clear show of unity. NATO wanted to show we are as united as we've ever been. And yesterday, we heard from the President of the United States, who had a very low profile in the initial hours of the summit, repeating the pledge from the U.S. to protect every inch of NATO territory is ironclad, and we will protect every inch of it. Then, secondly, there was a question about Sweden and NATO. We've now seen that President Erdogan has given the political go-ahead for that, but we now hear that he says do not expect this ratification to happen anytime soon. It will probably have to wait until the end of September, maybe even October, when the Turkish parliament goes back to session. And then, of course, the biggest question of all, the most difficult to tackle, and that was Ukraine and its future in NATO. Now, yesterday, all of the NATO allies agreed the future of this country will be in NATO, but again fell short of the expectations that the Ukrainians had. They knew they would not get a formal invitation, but they wanted a political one and felt the language around it. It's just it wasn't as strong as they were hoping for. Having said that, they did walk away with a pledge for more funding, weapons, and that G7 statement about medium and long-term security guarantees for Ukraine. Was it a success? I think it has to do with the expectations, at times the management of those expectations. But I had a conversation with a very senior European official who told me, look, I get it. I get President Zelensky. I would do the same. If I was fighting a war, I would aim for the maximum. But you have to look at it as a bigger picture story. And overall, it's unfair to say that this was a bad summit for Ukraine. They did not get that invitation, but they walk away with a promise for funding, a potential security structure on that guarantee from the G7, and again, the funding and the weapons, which is crucial and will be crucial for the counteroffensive.
So, Maria, you talked about some of the agreement there around Ukraine as well, but there were other tensions too. How united is NATO when it comes to Ukraine?
Look, there were real tensions, especially, as you say, when it comes to Ukraine, and they were palpable, and we could all see it. And we had that initial start pretty rough from the Ukrainian delegation with that tweet from President Zelensky, which really changed the tone at the summit. He talked about a circular conversation around NATO and Ukraine. Arguments at this point that he argued were absurd, to not grant this political indication. His body language on day one was also very frustrated. There was tension there. We also know in a story that I recommend everyone reads on the Bloomberg terminal that he was passed on a message to cool down, to bring in perhaps a more diplomatic stance in this negotiation. And we could see some recalibration, and we have seen it already from the Ukrainian president with a tweet at 2 a.m. in the morning, this morning, where he said, my message is thank you, thank you, thank you to everyone, all of our allies, and we're going back home with a good result for the country and our soldiers. Remember, at one point, also the U.S. Defense Secretary, the UK, suggested they should show more gratitude. I guess this feeds into that. Yesterday, President Zelensky said we have shown gratitude to the people of UK, to our allies, but if he wants a letter, I can also write him one and putting him right in.
Maria, thanks very much. Bloomberg's Maria today with the latest on that NATO story. Stephen, let's come to you. We've got quite a few stories that focus on climate this morning, and you've got one of those as your morning must-read.
Yeah, that's right. As we're talking in the broader context of this heat wave that's striking many parts of Europe as well, our opinion columnist Javier Blas has been looking at the issue of the Rhine River. Now, low levels in the Rhine River last summer, if you remember, interrupted some of the goods flow trade through the key crossing point of Kaub. And this year, it looks like we could be facing another problem there as well. As we look at this on this chart, the line in white is the average water levels at this key crossing point. And as you can see, it's very much trending towards the low level that we saw over the average of the past 20 years. So this is an interesting point to think about when we think about the importance of the Rhine to industries all across Switzerland, Germany and France as well, connecting them, of course, to the Dutch ports too. This is an issue that companies have been looking at solutions for, and that's what Javier Blas is writing about today, including a group of companies in Germany, like the chemicals giant BASF, who are looking at creating a new barge to try and be able to travel through lower levels of water through the river. And this is the solution, I suppose, an example of a solution coming from companies to try and tackle the symptoms of climate change. And as Javier Blas points out, this is companies trying to find workarounds for green activists. It's the wrong response, but for executives, this is a measure that can help to keep their factories running. So this new barge will be able to pass at a level where water is lower. As we know, that's the trend in the Rhine. Last summer, when we saw the Rhine levels dry up, this was something that actually knocked decimal points off Germany's GDP. So a really key issue, focusing on here. A short-term solution, though, as Javier Blas points out, there's going to have to be much bigger thinking around how to tackle issues like this, ever more present going forward.
Yeah, thinking about climate then, let's get to our next story, Stephen. Drought in Spain, which is going through yet another heat wave this year, is currently so extreme that virtually no aspect of daily life has been left untouched. This is as Europe endures its driest period in at least 500 years. For more, let's bring in Bloomberg's green editor, Siobhan Wagner. Siobhan, very nice to have you with us. Can you explain then how bad the situation in Spain is at the moment?
Yeah, it's pretty bad. Our reporting today focuses mostly on Catalonia, though, which quite frankly looks almost apocalyptic in some areas. Heat, along with historically low rainfall levels, has left reservoirs in the region in a dire state. They're currently at just 30% of their capacity compared to the rest of Spain, which is at 46.5. One reservoir that has been a particular concern is the Sal Reservoir, where there was so little water earlier this year that authorities were fearful that it would lead to massive fish deaths and contaminate the little water that was there. So they actually hired fishermen to come in and capture and destroy the fish, and the remaining water was transferred to a nearby reservoir.
Okay. Wow, huge steps being taken. How else is the government responding to this drought?
So authorities have declared an emergency over half of Catalonia. The measures impact about 500 towns, villages, including Barcelona. So this means shutting down decorative public fountains, bans on filling swimming pools, and using drinking water to clean streets or buildings.
How is this connected to wider problems then of heat and drought across Europe? Because there's not just, I was hearing people in Italy talking about the hot weather recently.
That's right, yeah. So as you just mentioned, Stephen, Europe is in the driest period in at least 500 years. Everyone, as you mentioned, is watching levels on the Rhine River, which is again, running towards critically low levels. Last year, we reported how the UK is facing water restrictions, which have been in some part driven by climatic changes. And then there's also El Nino, which is arising over the Pacific Ocean this year, and this is kind of altering weather patterns globally, and there's expectations that will bring higher temperatures into Western Mediterranean. And beyond that, like climate change, Europe is the fastest warming continent on the planet, and the world had its hottest week last week. And fortunately, as greenhouse gas emissions rise, the warming trajectory is not going to change.
Yeah, of course, and huge challenges for the economy with the result of that as well. Siobhan Wagner, thank you very much for joining us with the details of that story. Coming up, staying with the climate change theme, we'll be talking to Stefan Hartung, CEO of Robert Bosch, about the hydrogen's future in the world of car making. More on that next. This is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap. as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Markets Today, 43 minutes into your European trading day for this Thursday morning. And European equity markets moving modestly higher this morning, increasingly so, in fact, as we go through this morning's session. Now, let's stick with the climate themes that we were just talking about. Bosch, one of the world's biggest private companies, is announcing its plans for the hydrogen space at its 2023 Tech Day today. The German car parts giant says it will start volume production of a fuel cell power module and hopes to reach 5 billion euros worth of sales in hydrogen technologies by 2030. Now joining us is Stefan Hartung, the CEO of Robert Bosch. Very nice to have you with us, Stefan. Thank you for joining us. So you have big plans around hydrogen. Which sectors are you seeing strong demand from? Which sectors are you looking to supply?
Well, hydrogen is a carbon-free technology, and that's the key thing of it. So the sector first we address is obviously our home turf. That's the mobility sector. So we start with fuel cells for large and heavy vehicles for long duration runs. So that's trucks. So that's where we went in, and that's where we also started in China, as well as here in Germany and in the US. So you'll see these vehicles running on long duration. And this is this fuel cell power module, which is kind of the replacement for the engine. The vehicle later is electrically driven, and that technology is kind of the start. But actually, hydrogen is across all sectors, because you first have to produce hydrogen, then you have to use it to generate electricity or use it in vehicles. And that's pretty much a universal technology chain, which is here addressed.
What sort of changes is this making to other parts of your business? You've been very successful with diesel powertrains, for example, but that's a business that's fading away. Are you switching workers over from that business to hydrogen?
Well, that's why it's such an interesting technology, because it's not an easy technology, right? Hydrogen is something where you have to use all kinds of technical clues to get technology ready and also cost effective and efficient, because we don't want to waste energy, right? Green energy is a scarce resource. So the good thing is the technology we are developing with the fuel cells, the stacks, are all built on technology cores that have been used before in ICE technology. And that's why it's such a transfer on the development sides. That's why we're also going into this, because we can leverage technological cores, like, for example, metal to ceramic combinations, which are used in our technology in ICEs. These are very well suited also in fuel cells, and that's why we transfer people. We have transferred about 3,000 people into this area, and we will continue to invest in it for approximately 2.5 billion to harvest the markets then.
There's been a lot of concern, thinking about the broader German industrial landscape, Stefan, there's been a lot of concern about what's described as deindustrialization in Germany due to higher power prices and, of course, the global subsidy race, which maybe attracts investments to other parts of the world. Do you recognize those concerns?
Well, in general, we have to say, being an industry player in this times is definitely in a challenging environment. Absolutely, right? We are facing very high cost increases, not only in energy, but also in some materials, which are really important also for the green transformation, which we're standing in front of. The second is that regulation is changing a lot, and sometimes also making things more complicated, because the green transformation needs to be regulated. But definitely that's also for industry player a big change, huge investment necessities. At the same time, it's a burden that we don't have the demand now, which we would love to see. On the other hand, we also don't have the supply, which we love to have. So we're pretty much in a crunch. We come from a supply crisis with severe semiconductor shortages. We go kind of in a demand crisis with recession and consumer resentment, and that's definitely a difficult situation we all are in.
Stefan, you're talking about higher costs there as well. How are you making these sorts of scale of investments while facing those higher costs? Which bits of the business are you moving money from?
Well, it's all about dosing. On one hand, you can't print money, that's not possible, right? So you have to prioritize where you spend. On the other hand, it's clear that if we spend forward, we have to focus on carbon-free technologies. We have to focus on life-saving technologies, so accident prevention and those kind of things. For customer excitement, their lives, that's why we invented For Life as a motto. So one of the focuses is the carbon-free, and that's definitely a good one. So that's why we go into the hydrogen technologies, because we think that's definitely needed beside of the electrification technology, which we're much heavier investing in.
You've talked about how you're going to be supplying all parts of the economy at some point, Stefan, but obviously you're starting with transportation, and I know that trucks is a key focus. How confident is your business that Nikola, which is a business you're partnering here with, can overcome its financial and operational issues at some point and really make this happen?
Well, Nikola is a great partner because it has pioneered it. So this is going forward as a small company. They're going step by step, which is great. So in the perspective forward, we see that there's a substantial amount of trucks per year running on fuel cells worldwide. So it's not just Nikola, but Nikola is a good example how this works. You have to go step by step. This all will not come in a year or so. We talk about a decade-long roadmap, so we talk about things until 2030. And then we will also see unfolding of the necessity of these technologies in the wider scale. You see it now in China with multiple hundred vehicles. We see it with Nikola and others, and I think it will prevail.
Would you take part in any plans to pull combustion engine resources like Renault and China's Geely are doing?
Well, we have decided not to go into battery cell production, which I think is for us a real good decision because that's not what we can do best, right? But we are heavily also locating people from the ICE business to the electrification side, because even fuel cell vehicles are electric vehicles, and all the cars probably will go in massive volumes into electrification. So our biggest actually venture, what we're doing right now, is going into electrified component supply. We here go mainly for axles, also for electronics, electric motors and inverters, so electrical parts, high power electronics up to semiconductor. That's what we're doing in this business side.
This is a move, part of the green transition that you're talking about. We're also facing a heat wave in many parts of Europe at the moment. We've been talking about the difficulties navigating the Rhine River resurfacing again. How are you adapting your business in the short term to cope with these higher temperatures?
Well, in the short term, I think we can run the business as it is. We are not very much energy intensive because we're a technology player. Our footprint is worldwide, so we are active on all regions of the world. So in this sense, I would say, yes, it's a burden. We have also faced the heat wave on Monday and Tuesday and had sweat on our stages when we had a meeting with all our executives. But, you know, that's life how it is so far. It should motivate us to go even further in the CO2 neutral technologies.
Stefan, thanks very much. Thanks for joining us. Stefan Hartung, the CEO of Robert Bosch. Coming up on the programme, dollar confidence wanes as US inflation cools, but the pound firms amid signals of economic resilience. We'll dive into some of the market moves of the morning. That's next. This is Bloomberg.
expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Markets Today. We are nearly 54 minutes into the European trading day, and we are seeing European stocks pointing higher this morning. A fifth day of gains on European stocks after the big rally that we saw yesterday in the wake of that softer CPI print in the US. Tech and luxury stocks driving that rally in Europe today. Let's get to what's moving markets with Eddie van der Walt from our Markets Live team, who joins us now. Eddie, let's start with the FX markets and the moves, the softening of the dollar, strengthening of the pound.
Yeah, look, you look at the FX market, it looks like an easy trade. Everything is up today. But of course, that's just the flip side of the dollar. The dollar has had a rough old time because, you know, we've seen those inflation numbers coming in below expectations. You're seeing, therefore, traders scaling back their expectations of rate hikes in the US, and therefore you see currencies across the board up. Now, that will, of course, put downward pressure on inflation in all of these other jurisdictions. So pretty much helpful for central banks.
Okay, so that's an interesting worth noting, of course, given we have got strength elsewhere, weakness in the dollar. What about the China angle of the morning? I mean, there are a couple, aren't there? There's the trade data, there's also tech. Let's start with the trade data, the weakness in the export numbers coming out of China.
Yeah, the data coming out of China, the hard data has been significantly worsening over the last few months, right? We had first their inflation numbers and now the export prices. It really seems as if the rest of the world just isn't buying as much of Chinese goods, and therefore, you know, they don't get those big exports, which in turn then feeds back into the inflation story. But as you say, that's not the only story that we're getting out of China. There are some positives out there as well.
And the tech sector pointing, and it looks like it's bleeding across into Europe as well.
Right, and I think the reason is that you know, the authorities are starting to realize that they cannot hit the economy from all sides. If you're seeing a slowdown, you can't also punish your tech sector. So we're seeing the Chinese authorities taking a little bit of pressure off the tech sector, and therefore we're seeing a little bit of an improvement there, which should feed back into Europe.
Okay, Eddie, thank you very much. Eddie van der Welt joining us there from the Markets Live team. Remember, you can get up-to-date analysis and insight from Eddie and the rest of the MLive team. MLive Go is the function to use on your Bloomberg terminal. And Stephen, to your point there about tech, it is the best performing sector here in Europe this morning, isn't it? As if that is having something of an impact. And we remember, of course, the pressure that the tech sector was under at a time when we were talking frenziedly about just how many hikes were in front of us. And so it's that sort of interest rate sensitivity that's once again to the fore.
And the AI rally not over, it appears, anyway, for now. I mean, this is the other kind of part of the story. We heard about Elon Musk talking about his new venture into AI as well. There's more on that story to run too. So the question is, you know, how different will that be? Interesting to watch the changes coming to on the NASDAQ as well.
Yeah, and more news flow around AI coming through on China from a regulatory perspective, from Europe, onto the launch of new AI tools. So plenty to talk about there as well. That is it for Markets Today. You can get insights from us and the rest of the Markets Today team on the front page of the Bloomberg UK website by typing TLIV Go on your terminal. That will also take you to that blog. The Pulse is up next. They'll continue to take you through the reaction, ongoing reaction really, to the weakness in CPI in the US. This is Bloomberg.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. The slowdown in U.S. CPI bolsters bets that the Fed is near the end of raising rates. Doubts remain about the persistence of slowing inflation. China's exports fall for a second straight month in June, adding to the economic pain that has hampered the nation's recovery. Plus, the UK economy shrinks less than expected in May as consumer spending proves resilience and labor strikes ease. Now, also coming up on our weekly Bloomberg UK show, a deep dive on Britain's plans for startups and an exclusive interview with TikTok's general manager for operations in Europe. But first thing is first, so let's get straight to some of the overview of the markets. This is the European markets map. A lot of the focus, of course, on CPI, so dollar, which we're seeing moves across the board. Investors still responding, of course, to that important CPI data that was released yesterday, showing that the inflation rate actually slid to a 2-year low. That's really easing some of the worries out there in certain parts of the markets of higher interest rates and a potential recession. The question is, we haven't really seen a huge repricing when it comes to cuts. Does it still mean higher for longer? And what happens after the next move? The picture across the board, you can see the UK, the FTSE, the DAX, and the CAC getting between 0.2%. We're also getting some breaking news out of the IEA. I'm really looking forward to our conversation with Toriel Bozzoni shortly. It's cutting its global oil demand outlook for 2023 as they think the economy is staggering. I think it's important to then really try and break it down, whether this is weakness in China, because we've also seen some encouraging figures in terms of oil demand into the driving season in the U.S. Now, first thing is first, joining us to discuss the markets and really that CPI print that kind of changed everything, or potentially could change everything, is our Valerie Teitel, our markets reporter. So, Valerie, good morning. When you look at the market reaction, really to that soft U.S. June CPI figure, does one data make a trend?
Look, this was a really good print for the Fed. Not only did it come in soft, but those key components, the sticky core services ex-housing components, fell quite rapidly. And all of this happening without any labor market pain. It really gets you thinking that there is a big dent in that argument now that the hard work of getting inflation from 4 to 2% is still out there. Now it doesn't look that hard. It's falling without any labor market pain. Perhaps this is just opening the door a bit wider to the soft landing. But
The market reaction and the fall through today is a positive one. The key for me is that that 2-year yield is dropping another 10 basis points in this session. The dollar is roughly unchanged, but it did move so much yesterday, had one of its worst sessions this month. That's as we reprice our Fed expectations that it's one and done.
Yeah, some say it's almost too good to be true. What about inflation in the UK? The Bank of England governor is also expecting to come down, but it's a little bit stickier than elsewhere.
Yeah, the UK is still in a different bucket. We're getting these positive economic upgrades, but it's not really good news for the UK consumer or for the Bank of England, because the longer the UK economy stays strong, the more entrenched inflation is going to be. You know, we do get UK CPI next week. Core CPI is still hanging out on a 7 handle. And these expectations for where the Bank of England Bank of England base rate has to go keep going higher and higher. 6.5% is where we are now. Some banks calling for 7%. That's going to be painful for the UK economy down the line.
Valerie, thank you so much. Valerie Teitel there, looking at US CPI and, of course, this GDP out of the UK. We also have a podcast with Adam Posen, and he's saying, look, we could see a terminal rate of 7% in the UK. Now, off the back of that IEA report, we're also very pleased to have this conversation on oil with the IEA head of oil markets, Toril Bozon. Toril, as always, thank you so much for giving us a little bit of your busy schedule. First of all, talk us through where you're most worried about demand. Is it China and some of the Asian economies?
Good morning. So as we see in this report, we have revised down our global forecast for 2023 for the first time this year. We're seeing weakness, especially in Europe, as the manufacturing remains weak. We're also seeing some negative sentiments in China, but Chinese demand has been holding up very strongly, and now the expectation for this year is that Chinese oil demand growth will be 1.6 million barrels a day, and that's 70% of the global total. So while the economic outlook for China remains fragile, the recovery is losing steam, as we say in our report. The oil demand is really holding up. We're also seeing a lot of the growth in China coming from the petrochemical sector, and this is putting steam cracker margins in the rest of the world under pressure. So we have lowered our forecast for oil demand in the Middle East and other countries that export petrochemical products to China. We're also seeing weakness in Africa, where higher fuel prices are putting imports and demand under pressure. So it's a mixed picture. Oil demand growth, as I said, we have revised it down, but we're still expecting 2.2 million barrels a day of growth this year, which is robust, but is slowing into the end of the year and in 2024.
So, Toril, does the global market stand to tighten quite considerably in the second half of the year?
Yes. So far, as we say in our report, the OPEC cuts that were put into place last November has so far been offset by increased supply for other producers. We saw core OPEC plus producers cutting production by about 2 million barrels a day from October through June. But at the same time, we see increased supplies from other producers, including Iran, has increased production by about 500,000 barrels a day over the period to reach a 5-year high. We're also seeing higher supplies from the US, natural gas liquids, seasonally higher biofuels, other producers such as Brazil ramping up production. So far, those cuts from OPEC plus producers have helped supply, has been offset by higher supplies from other producers. But from this month, the additional cut of 1 million barrels a day from Saudi Arabia, lower exports from Russia, will lead to a steep decline in supply for this month and next. And with demand rising seasonally, we see a global oil demand increasing by 1.6 million barrels a day from the second quarter to the third. And with limited gains in supplies from other producers, we're expecting a sharp tightening of market. OPEC production can be about 2 million barrels a day below the demand for its crude this month, 3 million barrels a day in August. So a significant tightening for the second half of the year.
But Toril, is the IEA actually disappointed about Saudi Arabia's decision to prolong the production 1 million barrel a day cut into August?
It remains to be seen. As you mentioned in your introduction, the Demand is under pressure. We'll have to see how things work out, but and OPEC meets on a monthly basis, so they of course have the ability to increase production again if the market tightens sharply. We are seeing those cuts putting pressure on prices already. In the last few days, crude price has been up by about $5. We're seeing increased pressure on the sour market with the Asian benchmark Dubai and Urals, Russian Urals, increasing more than the light sweet crudes in the Atlantic Basin. So we are seeing a tightening of market, which could have a negative impact on the global economy and oil demand. So this is something that we're watching very closely.
I mean, does Brent's rise to $80 yesterday, mark a turning point for where oil prices are headed?
I think so. So far, for the past 4 months, we've seen crude oil prices trading relatively narrow band, as the market has been more or less balanced. But this is about to shift, and we're seeing that now. Oil on the water has come down markedly. It is going to translate into lower inventories on land, and as demand increases seasonally, we do think that there is a risk that prices will continue to increase into the third quarter and the remainder of the year.
So should consumers actually brace for some of the renewed price gains in the months ahead?
Of course, there will definitely be volatility in market. We see that as inventories, OECD inventories are still below the 5-year average. The buffers to deal with increased demand seasonally, demand rises seasonally in the US as the driving seasons, Europe heading off for vacation, jet fuel demand, road travel is increasing. And with supply tightening at the same time, we definitely see the possibility of volatile market and a potential upward pressure on prices.
Toril, as always, thanks so much for joining us, the IEA Head of Oil Markets, Toril Bozzoni there. Now, coming up, battered by rising interest rates, we'll ask if there are any green shoots for the leveraged finance sector in Europe. That's coming up next, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now, the outlook for the European leveraged finance sector is deteriorating. That's according to a report from Fitch Ratings. The agency sees default rates continuing to rise as slowing economic growth and rising rates prove to be a strain for highly leveraged borrowers. Now, while my next guest agrees there are downside risks, he also believes there are green shoots in the leveraged debt market as issuance volumes recover. Well, Daniel Rudnicki-Schlumberger, head of EMEA Leveraged Finance at JP Morgan, joins me. Thank you so much, Daniel, and welcome to the program. So you see some of these green shoots, but actually the economic environment is tough for some of the products and certainly for leveraged finance. Where do you see the green shoots?
Well, Francine, first of all, thank you for having me here. Green shoot, first of all, in terms of issuance volumes, we've reached a bottom late last year, and now we're seeing more issuance. Every quarter is better in terms of issuance than the previous one. That's very much driven by refinancings. And typically, we're a market where refinancing and M&A related financing are half and half. 75–80% of the financing we've seen this year are
How are you doing
refinancing.
today? I'm placing an order to buy Bitcoin. I'm looking to buy Bitcoin at the price 30,350. So if you're looking to buy Bitcoin, you can place your order just right here and wait until it will get filled. Okay, guys, I'll speak to you later. Stay safe.
If we have a real recession, spreads could be 300 to 500 bips higher than where they are today.
But you have to be pretty confident in your business model to be able to refinance now because you don't know what's coming in 12 months.
Well, but you're taking more risk by not refinancing, right? There's a lot of uncertainty, as you said, macro, geopolitical uncertainties, quantitative tightening. The ECB has 5 trillion of balance sheet to reduce, mainly invested in bonds if it wants its balance sheet size to go back to where it was. So the cost of debt could actually be quite a lot higher. You, as a CFO, you could look quite smart having refinanced this year.
And also quantitative tightening, right?
Yeah, quantitative
because of that, and that will, of course, continue. What's surprising you the most when you look at where we are in the cycle, and I guess some of the pipelines going through, some of the refinancing, everything seems to be holding okay. Is that a surprise?
So far, so good. Now, one of the beauty of our market, in particular the high-yield market, is that it's self-healing, right? 400 billion of high yield issued in Europe, yielding on average 8%. That's 32 billion of interest, which generally, if there are no outflows, are going to reinvest itself in the market. So there's an ecosystem. Refinancings can get done. Even acquisition financings can get done today.
Yeah. But I mean, it's self-healing unless it all comes crashing down. And there are concerns, for example, about commercial real estate in certain pockets. Again, when you look at some of the high-yield leveraged finance, are there certain sectors where you worry about viability in 12 months, 18 months?
Look, I'm not sure if it's leveraged finance specific, but obviously certain sectors like more consumer-exposed sectors are more worrying than others. That said, the need to refinance is there for all of these sectors, and looking forward to 2024, 2025, sometimes even 2026 maturities is something we're engaging our clients to do, and which is explaining the current revival we're seeing.
So when do you these are green shoots. When can you actually say, look, victory, we're done, we're in a much better footing, like maybe we were like 4 or 5 years ago?
It's going to take a long time. Our cycles are usually 7 to 10 years. Yeah. And we're, in my view, at the beginning of a fairly long cycle. Leverage levels for new transactions have gone down. Cost of debt has gone up. We're starting to see M&A activity and M&A related activity picking up. Yeah. But it's going to take a long time to go back to the levels of activity of, say, 2021.
So what's been holding back M&A? And there's one thing that's quite surprising when we speak to chief executives, that there seems to be a mismatch in what buyers are ready to pay for a company and the ones that are ready to, to sell for. Is that because interest rates and the risks of the economy basically turned quite quickly?
I mean, like all private markets, it takes time for buyers and sellers' expectations to adapt. I would say for the 2022, the lack of financing or the difficulty to finance transaction probably was one of the main causes of M&A slowing down. That's not the case anymore. Debt is there, and we're starting to see very large transactions, say, the take private of Software AG in Germany by Silver Lake, that's a $3 billion plus LBO, or in the US, Univar, acquired by Apollo for more than $8 billion. So large M&A is doable. The key, as you said, is finding that middle ground between buyers and sellers.
But you also mentioned sectors that everyone's talking about at the moment because it's skewed toward technology. So does it make a difference in what industry you're operating?
Yeah, non-cyclical sectors are a lot easier to find.
What's the one thing that you think will surprise? So we talk about U.S. inflation coming down, so maybe interest rates won't have to go up as much as maybe some in the markets thought, but then they could stay here for a long time. What does that mean for the kind of, how does it impact your industry?
Look, I would not over-index and overvalue short-term changes.
Yeah.
We have a longer-term perspective. Short-term, it's good. The current spring of leverage finance is continuing. I think the uncertainties, the medium-term uncertainties we discussed remain.
Yeah. When you look at private markets in general, again, there's a lot of concerns or questions about valuations. Is there anything that actually makes you uneasy about the next 12 months? About something breaking in certain parts of the market?
Look, a lot of things could happen. What we can do, what CFOs, what owners of companies can do is be cautious, look at their long-term financing needs, be prepared for uncertainty. We're going to remain in an uncertain environment. And if they are, they're also going to be able to benefit from these uncertainties.
And Daniel, does it make a difference if you're in the UK or if you need to refinance, of course, in Germany and France? I imagine the macro environment that impacts your thinking, influences you in different ways.
The euro market is deeper, certainly, than the sterling market, although there have been high-yield bond issuance in sterling. Where your end markets are matters as a credit matter a lot more than where your company is located. And there are a lot of great UK businesses with very international operations that have been tapping the leverage funds markets on a regular basis, including the past 6 months.
Daniel, thank you so much for coming on. Daniel Rudnicki-Schneeberger, their head of EMEA Leverage Finance at JP Morgan, for a robust conversation on debt and leverage. Coming up, we'll discuss what we've been learning from a busy NATO leader summit in Lithuania and what it all means for Ukraine. That comes next, and this is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters or your advisor?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back. Now, NATO has wrapped up a two-day summit in Vilnius, signaling Ukraine belongs in the alliance, but falling short of a clear timeline for membership. Now, despite initial tensions, President Zelensky thanked allies for their support and held G7 security guarantees for Kyiv. Meanwhile, President Biden, who's in Helsinki today, reiterated allied support will not waver. Now, let's get more from Bloomberg's Maria Tadeo in Vilnius. Maria, I don't know whether the summit is a success or not, but certainly President Zelensky was pretty disappointed yesterday.
Yes, and Francine, it's always the toughest question to answer. Was it a success? And a lot of it has to do with the expectations, but also the management, and at times the mismanagement of the expectations. But if you think about the key topics going into the summit, one was a fundamental show of unity when it comes to NATO. And yesterday, President Biden repeated, when the United States says we will defend every inch of NATO, we mean we will defend every inch of NATO. The other big topic was, of course, Sweden, and we have seen that President Erdogan has now given that political go-ahead to the country, although now he says the ratification may take longer than expected. He suggests that the Turkish parliament could vote on it at the end of September, maybe even October, so they will have to wait until it goes back into session. And then, of course, and you alluded to this, the toughest question, the most difficult issue to tackle, Ukraine and NATO. We did see real frustration from President Zelensky, especially at the start of the summit, a very angry tweet in which he said a lot of these topics and some of the arguments that we hear are just absurd. We've been here before. We need a political signal now. They did not get the formal invitation. That was never going to be the case, but they wanted that political indications. The Ukrainians manifested that they wanted stronger language, and they did not get it. But nonetheless, I would point to a conversation I had with a very senior European official who said, was it a success? Will they walk away with weapons, funding, and a G7 commitment? Did they get everything they wanted? No. But again, it was about managing those expectations, and those weapons, funding, that will be crucial for the counteroffensive.
Maria, thanks so much, Maria Tadeo. They're in Vilnius, Lithuania. Coming up, our weekly Bloomberg UK show. In the spotlight this week, a boost for startups, a listing rules shakeup, and an exclusive interview.
Connection lost.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more
on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Well, good morning, everyone, and welcome to Bloomberg UK, a special focus on the biggest challenges facing the British government, the economy, financial services, and, of course, the markets. I'm Francine Lacqua here in London. Now, in focus this week, the landscape for Britain's startups and SMEs. The UK government has big plans for small businesses. They come in the form of a series of reforms announced by the Chancellor, Jeremy Hunt, this week. So what's involved? Well, firstly, an agreement between 9 of Britain's largest pension providers to increase their investment in growth companies.
The Compact, which is a great personal triumph for the Lord Mayor, commits these DC funds, which represent about 2/3 of the UK's entire DC workplace market, to the objective of allocating at least 5% of their default funds to unlisted equities by 2030.
Well, the Chancellor's also pledged to help grow the base of listed companies on the London Stock Exchange after an IPO drought.
Between 1997 and 2019, there was a 44% decline in the number of domestic listed companies in the UK, part of a wider trend across Western markets, with the US and France seeing even steeper falls. I want the world's fastest growing companies to grow and list right here, making LSE not just Europe's NASDAQ, but much more.
So an ambitious plan, but is it achievable? Joining us now is Bloomberg City editor Catherine Griffiths and our senior UK economy reporter Phil Aldrich. So thank you both for joining us. We also have GDP in the UK, so we need to look at the context, of course, of some of these smaller companies in the wider economy. But it was a big week,
yes,
right, for a lot of these smaller companies. Will it make a meaningful difference?
It probably will make some difference. I think it's really open to question how much difference, but certainly these big pension funds, the big insurers that manage their money, have said they will put 5% of their funds, which could be £50 billion or maybe a bit more if they go further, into startups. I suppose the question then is which startups and at what level and what then happens. So lots of questions.
Yeah, do we know? I mean, it could bring in about 80 billion. But again, it's quite difficult. I mean, these are startups that you don't know if it's viable or not. So you don't know at what point you enter as an investment and whether you get anything back.
For sure. So I think their answer to that is, well, you know, if you have a big, wide group of startups that you have exposure to, then the hope would be that overall you'll make more money that way.
So the UK economy is stronger than expected. Overall, and this was a GDP figure that we got today, but it's tough actually for the Bank of England governor. We heard him on the financial stability. Phil, you extensively wrote also about these 4 million households that face a huge increase in mortgage payments.
Yeah, so the GDP numbers were better than expected, and the governor, the Bank of England, has been saying the economy is more resilient than people had thought, and so that's been borne out in these numbers. At the same time, particular households, are feeling quite a lot of pain. But the point on these households is there's half of the mortgage owning households, so about 4.5 million, have already remortgaged. There's 4 million still to remortgage. So this process of moving people onto higher rates and hitting their spending power is relatively slow. And this is sort of one of the problems that is meaning that the economy is proving to be more resilient. As the governor said yesterday quite clearly, effectively we are trying to inflict pain on households to get them to spend less so that we can bring inflation down. Slightly stronger than expected GDP print, and the fact that this pain is being fed through quite slowly is making it much harder for the bank to tackle inflation.
I mean, we also heard at the Mansion House speech where Catherine was, the governor talk about inflation coming down more quickly than expected. Now, I don't know whether, Phil, when you take a step back, there's been so much negativity about the UK economy. Could inflation actually come down almost as quickly as it came up, or is that just wishful thinking?
So it's definitely the case that the structure of the UK economy means that our inflation came through a little bit more slowly and is dropping away more slowly. And what we're seeing in America at the moment is the headline rate comes down, and as a result, sort of wage employees is then seeking less pay or lower pay rises. So you get this sort of second round effect on the way down, and that's what the governor was talking about in Mansion House, that you get this. The headline rate drops, that's a good thing, but what you really need to do is get it out of the domestic wage setting part of the economy. But because people base their wage settlements on the headline rate, you then start to get it coming out of that. So he was saying it's going to fall markedly, but the main thing he wanted to get through, and I think the most important part, is that the headline rate falling markedly actually then leads to a sort of reduction in these kind of underlying pressures on wages to keep inflation higher. So that's what they're hopeful on, and we're seeing it happening over in the US. Are we going to see it here? Let's see.
The $1 million question. And then the other $1 million trillion question is actually, how does this economy grow, right? If you look at what the plan for the government is, did you feel, Catherine, that you, and first of all, you were on the podcast and it was wonderful because we really got a kind of like an inside look at Mansion House, which is kind of, the UK pompous, but also cooler, side of some of these events. But do they have a plan that will put them on a better footing in a couple of years?
I mean, I suppose their hope is that these startups of today, or actually the reality is not today, but in the next few years, become the bigger companies and the biggest companies of tomorrow and into the future. So the UK's 10 biggest companies were not created in the past 10, 20 years. They're old. So the whole idea is to try to find those big companies, mark international leaders of the future.
But at the same time, Phil, I guess what they need is to make sure that the housing market doesn't collapse, because the UK is so reliant on that. So where do small and medium-sized enterprises, where do they fit in this growth plan?
Well, this kind of growth plan very much fits in with what Rishi Sunak, the Prime Minister, what he's like. He's the Silicon Valley PM. He's a venture capital. The kind of venture capital chancellor, when he was chancellor, he put in place this sort of breakthrough future fund and the future fund to support startups before. So he and the chancellor now, Jeremy Hunt, always talks about the fact that we're the third biggest tech unicorn country in the world, and they basically definitely see the future of the economy built on life sciences, high tech, supercomputing, all this kind of stuff. And so to get that part of the economy going, which you need this sort of venture capital style money. Where that fits in with house prices, they just got to make sure that ideally you just don't see that crash in the housing market that destroys sentiment, that then causes causes households to stop spending.
But the Prime Minister, and he was Chancellor before, just can't get these companies to list here, and that's a huge concern.
Yeah, it's a huge concern. I mean, of course, the high-profile example of ARM was a real knock to sentiment. But, what the Chancellor Jeremy Hunt talked about at the Mansion House was the declinists. He was very against the declinists. And there is a sense, I think, of people kind of being quite keen on that narrative of negativity. But of course, to balance that, one has to look at the reality. So they really need to be able to start generating these concrete examples of investment going in and small companies becoming bigger companies. And of course, as you say, then them choosing to list in the UK.
All right, Catherine and Philip, thank you so much for joining us. Our city editor, Catherine Griffiths, and our senior UK economy reporter, Phil Aldrich. Now, coming up, we're joined by TikTok's general manager for Europe to discuss the business and its impact on SMEs and the wider economy. This is Bloomberg.
Tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture does.
Is it the OK's getting ready to make a decision?
Season is coming.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back. Now, as the UK government tries to boost investment into growth companies, short video platform TikTok has published a new report saying SME marketing spend generated more than £1 billion in revenue last year. Now, joining us to discuss all of this is Rich Waterworth. He's TikTok's general manager, operations for Europe. But Rich, thank you for joining us. I mean, TikTok is getting a fair share of criticism, which we'll get to in a second. But this is a survey that basically also shows the benefits that TikTok does and social media in general for business owners. How do you quantify it?
Yeah, well, thanks for having me. And we're really, really pleased to share this report from Oxford Economics. And to your question of how you quantify, the headline number is that the survey shows that £1.63 billion worth of GDP value in 2022 alone was being supported by small businesses on TikTok. So it's really a large number. We can see that it's growing quickly. TikTok has been around for 5 years. Only 5 years. We've grown to a user base of over 150 million users around Europe. And so we've been very lucky to grow quickly. And what we're seeing now is that businesses are tapping into that user base.
So, Rich, is that because it's an easier, cheaper way to get into the market than other platforms, than physical shops? Or is it because you're doing something right?
Yeah, I mean, one of the keys to TikTok is that it really lowers the barriers to entry. It makes it very, very easy to produce content. You can shoot content using a phone, very easy editing tools within the TikTok app itself. So for a small business, that means you can create content about your product, about your brand in minutes, very, very quickly and easily. So it is a very, very quick and easy route to market and tapping into that very large audience on TikTok. And the key thing is that the algorithm on TikTok will recommend your content to other people who are interested in the products and services you're providing.
I imagine, social media is fickle. We've seen with Twitter, and I think 10 million users now of Threads. Do you worry that business model can go away almost as fast as it came if there's a new social media platform like Etsy was the big thing 5 years ago? We don't really talk about that anymore.
So as I say, TikTok's been around for 5 years. We've been very, very lucky to see great adoption of the product. The community's grown significantly, and we continue to see significant growth. I think the key for us is, can we continue to innovate and provide value for businesses and users? And that is what this report is showing. There's a great phrase in this report that I love, where it talks about TikTok as a signpost to the world. And what that is about people seeing goods and services, products, entertainment venues on TikTok and then going on to purchase them or visit those. It's very much an action-based experience.
So this is a live shopping, right? We're looking at some numbers. Through Bloomberg reporting, I think you want to make that about a $20 billion business, which is huge. Does it work outside Asia, that business model?
Yeah, so there's a few ways that small businesses take advantage of the platform. Live shopping is one of them. Yeah. So live streaming and being part of TikTok Shop, which is our in-app marketplace where you can sell goods directly. That absolutely works in the UK. We're seeing great success with that. Small businesses from all around the world. I bought products from a bakery in Aberystwyth in Wales this week who are live streaming on TikTok. You can buy the product directly, shipped to your house within 48 hours. So that experience works very well. But small businesses can also promote themselves using content, using advertising on TikTok. There are many routes to using the app.
What percentage of your advertisers are small and medium companies?
So it's a large percentage of advertisers. The exact number, changes and varies over time. But small and medium-sized businesses, what we see in the report is that there are over 32,000 jobs supported around the UK from small SMBs using TikTok. Around 3/4 of those are outside of London. So it's very much a nationwide phenomenon. You asked earlier about lowering the barrier to entry. I think that is the key thing to understand. The other thing I think is really interesting here is that a high proportion of these businesses are coming from people who, less typically owning small businesses. So a lot of young business owners under the age of 30, and a lot of ethnic minority business owners, way above the national average.
But if you have a targeted ad, for example, from a small and medium company, do you worry that if people are not interested, it lowers the interest in your platform as a whole?
Yeah, absolutely, and that's why the systems that we build are absolutely about targeting those ads in the right way.
So the algorithm is you're dependent on the
algorithm. Exactly. The recommendation algorithm. The experience on TikTok is called the For You feed. That is the feed of videos. That feed on TikTok is based on a content graph, not on a social graph. So what that means basically is if you've enjoyed watching Formula One content on TikTok, if you've enjoyed watching Wimbledon content, those are both big on TikTok right now, other kinds of sports content that will be related to that would be recommended to you. So it relates it to the content that you're interested in.
TikTok has also come under quite a lot of pressure. French lawmakers, giving you 6 months, I think, to fix some of the security concerns. A lot of parliaments have had questions. How much time do you spend trying to lobby governments or lobby some of the security concerns as opposed to actually growing the platform in Europe?
Yeah, look, we take safety and security, of our users, of our data, users' data, extremely seriously. It's a huge priority for us. And we make massive investments in that. We comply with all of those data security laws around Europe, but we've also committed to going well beyond those. So we've announced a project that we call Project Clover. That is a project specific to Europe, where we'll be appointing a third-party data assurance partner. So that third party will audit and verify all of the processes and protocols we have around data
And governments
management.
Are happy with that? Or are they still kind of pushing you for more?
So we're engaging with governments, explaining all of that, and we get a very good response when we explain that. The other thing that we're doing is we are opening data centers around Europe so that all European user data will be by default stored within Europe, which governments are very keen on and very happy with. So we're making those commitments, which are actually way beyond what the industry norms are, what our peer companies are doing. And so, we're very, very focused on that.
Is that political pressure? And actually, if you look at the political landscape, I know the US also had a couple of things to say about TikTok, but is Europe the toughest market to get, MPs and parliaments on board?
I think the whole technology industry is being held to high standards, and the European Union has been a very proactive, regulator, and I think we've been very, very engaged with all of that. So, we actually feel very proud to say, okay, let's look at what Europe is requesting and see where we can go above and beyond that. That's something we think is in the best interests of the industry. It's something we think we're equipped to do and will actually be a benefit, both to TikTok's users, but also to the whole industry.
What percentage of your ad revenues are from Europe?
Well, so we don't disclose that specifically, but of course, Europe is an extremely...
Roughly? Can you give us a general idea?
We don't break it down in that way, but as you would expect, Europe is a really significant chunk of our ad revenue, just as it is for any kind of technology company in our sort of space. So it's a really, really important market for us, and an exciting one.
Rich, how do big news events, so for example, the riots in France, how do they drive adoption for TikTok?
Yeah, so people come to TikTok for all manner of things. They come for entertainment, they come for music, they come for sports, as I mentioned. They also do come to find out what's happening in the world around them. So people do consume, content related to what's happening in the news or what's happening in the world. So, that is part of the mix. But again, it very much depends on what you're interested in. If you are interested in that kind of thing, you would like to follow the news, you will get served that as part of your For You feed. If you're not, you'll get much less of it.
But is that like an extra 2 million, 200,000 adopters of TikTok when there's like a big news event? How can you quantify it?
I wouldn't necessarily put a number like that on it. It doesn't, change things that much. Again, it comes back to, I think the core user experience for TikTok is around entertainment, creativity, sport, music, all of these kind of things. So those kind of news events, probably not such a big impact on TikTok.
All right, Rich, thank you so much for joining us today. That was Rich Waterworth, General Manager Operations for Europe at TikTok. Now, coming up, we'll stick with tech and how the UK government reforms stack up as it tries to deliver the next Silicon Valley. This is Bloomberg.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, we've just heard exclusively from TikTok on how the company is helping to drive growth in small companies across the UK. The question, of course, was also on some of the pressures from politicians. Let's discuss these claims and how it plays into the UK's government's efforts to support tech startups. Well, Bloomberg Quick Takes Alex Webb joins us now. Alex, thank you for joining us. I mean, if you look at TikTok, they've come under so much pressure from so many parliaments in Europe. Is there really an argument that says, look, this is good for small and medium-sized enterprises?
I mean, it's fascinating that basically this is their playbook because they're copying it straight from big tech in the US. When you see Meta, Google, Amazon in particular go up on Capitol Hill in defense of whatever the latest claim might be, they are adamant about, look at what we do for small businesses, i.e. they advertise on our platforms, they sell services and products through our platforms. That helps small businesses. Now, small businesses in the US are a way more potent political football than they are in this part of the world. Don't think people sit around the dinner table so much and talk about the plight of small businesses. They tend to do that a little bit more in the US. At the same time, it's also really good for their advertising business. When Facebook made a huge play 5, 6, 7 years ago to really go after small businesses, SMEs in the Midwest, that made their ad business way more resilient. When you had the big brands vetoing them, pulling their ads off Facebook, it barely affected the business at all because they have such a long tail of small businesses. There's a kicker to all this, though. If you have loads of small businesses advertising your platform, often the quality of the ads suffers. Right. And that's one of the reasons we've seen a bit of a flight of engagement away from Facebook and towards other platforms.
But so, Alex, let's say you have a small business, Web Incorporated. Like, where do you advertise or where do you try and get customers? Instagram is trying to also do a live shop, similar thing. Is it Etsy? Can you get onto Amazon?
So, I mean, look, historically it has been Facebook because you can, with great granularity, target people. Now, the way Facebook was able to do that was it scraped a huge amount of data from across the internet. That's become a lot harder because of GDPR and also because of moves taken by Apple to stop data sharing between different apps. If TikTok is now saying we can do that basically through knowing exactly what people are like from what they are swiping, what they're watching, that's really fascinating. It says a huge amount about the accuracy of their data business. The proof is going to be in the pudding. We haven't heard much data from small businesses, from business as a whole, building businesses on TikTok. This live shopping piece is fascinating. Bloomberg reported that they did 4 billion revenue last year. Live shopping is almost like QVC on your phone. People saying, buy this lipstick, live streaming, you buy it right within the app. It's huge in Asia. Douyin, which is another business owned by TikTok's parent company, has really done well on this, as have other companies. It's never succeeded outside of the US. Instagram have tried it, Amazon tried it, YouTube tried it, not quite cracked it. The fact that they are now trying to grow that from 4 billion a year, that's gross merchandising revenue, to 20, requires the rest of the world. If they can do it, it'll be quite an achievement.
Alex, thanks so much, as always, for joining us. Alex Webb there from Quick Take. Now, Bloomberg Surveillance Early Edition is up next with Kriti Gupta in New York, Danny Berger in London. The focus will firmly be, of course, on the CPI numbers we got from the U.S. yesterday, what that means for future interest rate increases from the Fed and possible interest rate cuts. If you look at dollar, there's quite a lot of dollar move. And then the IEA also coming out with a report earlier this hour, cutting global oil demand outlook for 2023, as they think the economy is definitely slowing. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Okay, so you're moving in on me, quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Inflation ripples. Markets go risk on as the slowdown in U.S. CPI bolsters bets that the Fed is near the end of its hiking cycle. The IEA says global oil demand won't grow as fast as previously expected this year as developed economies falter. And Disney extends the contract of CEO Bob Iger for another 2 years, giving him more time to implement his turnaround and find a successor. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, the trade is still on. The disinflation trade, yields down, dollar down.
Yeah, and it's having a little bit of a ripple effect when you look at the stock market as well, specifically the idea that if you were looking at perhaps cheaper borrowing costs in the near future, plus a weaker entry point or a weaker way to hop into the stock market, aka the dollar, in theory, the stock market should go up, up, up. And that's kind of what's happening in futures right now, higher by about 0.4%, 45.23 for our radio audience on those contracts. But look, the bond market gets interesting here because, Danny, we're talking about this repricing. Perhaps we are near and closer to the end of the Fed tightening cycle. Although I have to say a couple days ago, that was not the narrative at all. Was higher for longer. But a 2-year yield is getting really interesting because already at 5 a.m. New York time, you are already seeing an 11 basis point move on the front end of the curve, 464 on the 2-year yield. The 10-year yield as well, same volatility, down about 4 basis points, and that's not even the biggest move of the pre-market session. So 381 there. It really speaks to the idea that this bond market is going back and forth very, very quickly. It reintroduces that bond volatility that I want to say was maybe missing in action for a couple of weeks, something to keep in mind as we go and really count down to that next Fed meeting at the end of July. I want to talk about Brent crude as well, because with that risk rally that you are seeing right now, you are also seeing the commodity complex get on board, and some of that might be a function of that weaker dollar trade that we are seeing, really following the bond market story. Anyways, Brent crude trading at an 80 handle, higher by 0.1%, Danny.
That risk-on mood is following to Europe. Despite some data we just got coming through, Critty, the Euro area May industrial production data has come in much worse than expected. It fell 2.2% year over year. The estimate was for a fall of 1.2%. So we're not really paying attention to the Europe data. We're paying attention to the U.S. data. So we're looking at basically all regions on MapGo on your terminal moving higher this morning, carried higher by some of the higher beta type indices. DAX is up 0.5%. Even UK stocks, Barclays says that they're cheaply priced, but still, the risks are there. It doesn't mean you should necessarily buy this index. So FTSE 100 up again 0.2%. Now, I mentioned that worse than expected industrial data. One thing to flag in this European stock market today is the underperformance of BASF. That's down 0.4%. Again, that's notable while everything else rallies today. It is a chemical company and it has cut its guidance. It's yet another chemical company in Europe that's cut its guidance. Langness also cut their guidance. Look, it's a bad sign because chemicals are used in literally everything, especially industrial companies. So it's not a surprise industry of Europe is lagging in the data we see. Elsewhere, it continues to be that inflation trade, Critty, the disinflation hopes. We're looking at German two-year yields, Schatz, that's getting bid today. We're down about 8 basis points. And sterling versus the dollar, I know we're about to talk about this trade with Valerie in just a moment, Critty, so I won't go on too long here, but we're at 130, back above 130 for the first time since April 2022.
You know, it's interesting that you mentioned that chemical sector in particular, because of course Europe is going to have way more exposure to that than the U.S. will, but still the ripple effects are going to be interesting when you look at those pre-market movers. But again, at the core of it is just how expensive things are getting, which brings us to the top story. U.S. inflation sharply cooled last month, offering fresh hope that the Federal Reserve can soon wrap up the most aggressive interest rate hikes in decades. Bloomberg guests weigh in on the data and its implications for Fed policy.
This was a good report.
An extraordinarily good print for the Fed.
The Fed should be pretty cheered by this.
Disinflation is starting to take hold.
But I don't think it changes what they're going to do at the July meeting.
I don't think it changes the move in July from the Fed.
I think the Fed will hike in July.
They can't take their foot off the pedal yet.
Could July be the last one?
If this is the new run rate, then yes, it would call into question hikes beyond July.
They won't move at the meeting after July. They'll take a break just like they did this last time.
That September hike is one where, you know, they could afford to skip again, given the way inflation's sort of behaving right now.
And then we're going to get to November 1st. Well, there's a long time between now and November 1st.
There's a lot of time between now and November.
The November rate hike is really up for grabs at this point.
Joining us now, Bloomberg's Valerie Teitel to walk us through it. Valerie, look, we're still waiting for PPI data. We got some positive numbers, perhaps, when you look at the core or the super core, if you'll nerd out with me there. Walk us through this trade that we're seeing right now.
Look, it is immaculate disinflation. We're seeing inflation fall in these sticky components without any labor market pain. The follow through today, especially in the London session overnight, is notable. That two-year yield sinking another 10 basis points. I was just checking on my Bloomberg screen. It's dropped nearly 25 basis points in the last two sessions. The thing that stuck out to me is on this chart here, Critty. Let me go over it quickly. The Fed funds rate is now trading above core inflation for the first time since 2019. Now, this is notable for markets, and this is a signal that the cycle is nearing an end, because Powell has really drawn markets' attention to this narrative around a positive Fed funds rate, around positive real yields, and with yesterday's weak inflation print, we got there.
We also got UK GDP data in, and I mean, the UK economy continues to stand out for, I guess, its resilience, but not necessarily in a good way, beating expectations. What does this portend for what it means for the UK inflation story versus that of the US?
Yeah, a slight beat when it came to that GDP print today, and it comes along, you know, maybe a string of positive, more positive than expected data prints from the UK. All I can say is that when I look at my Bloomberg terminal, I'm really happy that gilts are following this Treasury move. They're not necessarily reacting to this positive GDP data like we'd expect, but we're seeing you know, an 8 basis point rally across gilts, and cable is strengthening. You know, that's basically following on from dollar dollar weakness. But again, this is not the time that the UK needs to have a string of positive economic surprises. But we say that with the guys that now we know. Well, I don't want to say we know, but now we can assume the Fed isn't going to 6%.
Yeah.
There's going to be a little less pressure on the Bank of England to get to 6.5, 7. I know we've had some quite crazy numbers from the street thrown out about how high they have to hike. So possibly a bit of pressure off the Bank of England because the pressure is now off the Fed. But still, it's about that core CPI print we get next week. My eye's going to be on that UK inflation print next week.
Certainly something we're going to be keeping an eye on. Bloomberg's Valerie Teitel all over the trade on both sides of the Atlantic. Now, what's interesting is what she was talking about with the inflation story, because remember when commodities was driving inflation? Well, it's not anymore. Global oil demand especially not planning to grow as fast as previously expected. That's according to the latest report from the International Energy Agency. The head of the IEA's oil market division spoke earlier on Bloomberg.
We're seeing weakness, especially in Europe. As the manufacturing remains weak, we're also seeing some negative sentiments in China. But Chinese demand has been holding up very strongly, and now the expectation for this year is that Chinese oil demand growth will be 1.6 million barrels a day, and that's 70% of the global total. So while the economic outlook for China remains fragile, the recovery is losing steam.
Joining us now for more is Bloomberg energy reporter Anthony DePaolo. Anthony, walk us through this. What happened to the oil demand supercycle narrative of, I want to say, even a couple months ago?
Yeah, that demand is still increasing. We are going to hit a record demand this year as we're recovering from COVID, getting back past those 2019 levels. So we are increasing still there, but just not as quickly as had been expected earlier. Now, a lot of that comes down to, as you guys have mentioned, the fears and the concerns about economic weakness in the West, and that sluggish recovery in China. The market is still looking at China for needing that recovery, bringing in more oil there, and that's really one of the keys that will pull this oil market along. And we're seeing that happening, but at a more sluggish pace. So traders are still watching that. They're still concerned about that. The increase in Brent crude over 80 yesterday just really underlines how much traders are watching the Western economies. It was that slower than expected inflation that came out from the U.S. yesterday that kind of really pushed oil above 80 for the first time in a couple months, really. So that was what was seen as the positive news there, Kritti.
That $80 a barrel, that's not the only thing that caught our eye. Also $60 a barrel on Urals on Russian flagship oil, which of course is above that price cap set by sanctions from G7 nations. Anthony, if we've seen Russian oil prices go above that price cap, does that mean sanctions just aren't working?
Yeah, Danny, well, that creates an issue for some of those buyers that have been taking a lot of the Russian crude because they need it to be below that price cap in order to get all the services from G7 countries like shipping, like insurance, and that makes those transactions basically free of the risk of sanctions from the U.S. on those transactions. So when those transactions go over the price cap, that's where they get at risk, and potentially some of those buyers will have more difficulty doing those deals. Now, we've spoken a lot about this so-called dark fleet, a group of tankers that are outside of the Western insurance system, that are maybe owned by Russians or other companies that are taking those barrels without needing these kind of Western services. So potentially there's enough there to continue carrying that oil. A lot of the traders that we're speaking to expect China to continue taking a lot of those barrels. India has been taking a lot of Russian oil as well, and perhaps there's some issues there. They don't want to run afoul of those sanctions, but again, they want to keep getting those cheaper barrels and continue making sure that the oil market is well supplied. So this becomes an issue, but we'll see again how that Russian crude reacts and whether it stays above the price cap. The main thing has been to kind of keep Russia from getting those higher profits from the high oil prices. That's been marginally effective, so we'll see how that continues going on now that we have breached that price cap, Danny.
Anthony, thank you very much. That's Bloomberg's Anthony DePaolo there. Let's talk about Disney. It's extended the contract of CEO Bob Iger for another 2 years. The company announced that Iger will remain in the top job through the end of 2026. Joining us now is Bloomberg Quick Takes Alex Webb. Alex, Iger's been very successful, hence why they're keeping him in, but I guess successful at everything except finding a successor.
Yeah, successful succession. I mean, that's ultimately the two reasons why they're keeping him in. Investors like him, studio seems to like him. He's very astute and adept politically. His predecessor and previous successor, Bob Chapek, ruffled a lot of feathers while he was briefly in the role. But the fact that he's extending from the end of 2024 to the end of 2026 indicates they don't really have a clear successor in mind, or if they do, they possibly think that person needs more grooming. We don't know who it might be. So it's very much sort of mixed news for investors. They like Iger. They would also like to have probably a clear idea of who his successor is.
Well, Alex, talk to us about the Disney kind of business model here. You know, we talked about how well-liked Bob Iger is. I think he's extended his contract in his first iteration as CEO 4 times before then being reinstated, as you just point out. The market clearly likes him, but what exactly do they like about him? What piece of his leadership or strategy is really appealing here?
Well, on the one hand, he is very adept politically, as I said. Secondly, he has a pretty clear vision about what the studio should be, how it should be making money. He made some very astute acquisitions over the course of his time. First stint at Disney, think about Pixar, Lucasfilm, Star Wars production house, and of course Marvel, which has become a behemoth. But he also managed to pivot Disney at the right moments. Disney was a company that had, quite a healthy dividend for much of its time. He started piling into Disney Plus just at the time that Netflix was doing really well. Now, that was a slightly poisoned chalice, of course, because it meant that Disney, look at that stock chart we just saw, it did very, very well during the lockdowns because interest rates were low. That meant that people were searching for growth. Disney Plus was growing really quickly. And, of course, consumers had the time to watch Disney Plus. As the heat slightly came out of growth stocks and interest rates increased, Disney was perhaps in not a very good position. So he's now starting to pivot back towards that dividend-paying business, which is something that activists have been asking for as well. So it's that affinity for what the capital markets want, as well as a firm grasp on the strategy of the rest of the business.
Alex, thank you very much for that update. That is Bloomberg Quick Takes Alex Webb. Coming up, we're going to talk about this macro environment. After yesterday's CPI numbers, we'll be speaking to Skylar Montgomery-Conan, global macro strategist at TS Lombard. And with inflation still not low enough, workers are looking for more money in their pockets. We're going to be discussing the high-profile labor actions taking place from Apple, UPS to Amazon, and what it could mean for inflation going forward. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Look, Danny knows this well. I get obsessed with certain stories, certain dynamics in the market. It was regulatory last week. This week, it's all about labor, especially in the show, which is handy because we just got some super core data that is truly historic. It's actually, we're seeing the first monthly drop in the super core numbers going all the way back to mid-2021. Now, you might ask, what is actually in this basket? Because, hey, I did Google it before the show, and it's really all about the services sector, things like medical care, transportation, education, even garbage collection, essentially a lot of the sectors of this economy that are really reliant on things like labor, except if you actually look at the inflationary story, it doesn't look like wages are coming up. Now, if you are earning and inflation is high, you are, of course, making fewer real wages. Your dollar goes further, or less far, I should say, or whatever currency you're trading in or buying in. You can tell I'm a financial journalist here. What's important to keep in mind is that the wage story is not keeping up with the broader inflationary story. It's a theme we're going to discuss in the back half of the show. The question is, what do you do with seemingly positive information like that? Let's bring in a true expert. Bloomberg's Eddie Vanderwall has all the answers for us. He's our deputy managing editor over on the Markets Live blog. Eddie, does the wage data or lack thereof matter here?
Yeah, way to set me up to fail, Kriti. Thank you very much. Look, that supercore number is really, really interesting. It is coming down. That is undeniably good news. It is coming down too slowly, and it is still too high, right? I think when I look at that number, what I see is, yes, the Fed is going to hike in July because they said they're going to hike in July. They're probably going to pause a little bit afterwards and see how much it's coming down. But the reason we look at supercore is that is the most sticky part, the most, the one that tends to change the slowest. And that is still well above where the Fed would like to see it. As long as that remains the case, I think there are still further hikes further down the road.
One of the consequences of the CPI number yesterday has been this massive tech rally. We also see it in Asia. But Eddie, one of the things that I'm trying to figure out, and I know you saw this story too, of more positive sounds from policymakers in China around tech. I mean, a lot of China stories. We also had weaker exports. How are you reading China tech today?
Yeah, I think this is part of China wanting to stimulate, right? Because China, I think the policymakers, I think the authorities there are saying, look, our economy is getting hit from all sides. Maybe the tech sector needs a bit of a break, right? And I think that's what they're doing. They don't want to go all in at this point and put more pressure on the tech sector. I think that's quite a positive development because I think Europe needs a strong China to get back on the front foot. So if China just takes a little bit of pressure off the tech sector, which is what we're seeing at the moment, that could spill over into European stocks too.
Well, Eddie, talk to us about the read-through there, especially not just from kind of a regulatory or kind of a even post-COVID policy, but more from a infrastructure stimulus kind of policy. Does it matter what, say, the PBOC does, for example, for a U.S. or a European market?
It definitely matters. I think I was speaking to, colleagues here in Bloomberg yesterday, but just about how China stimulates and whether they will be successful. The big question, there's really two questions to answer here. Number one, will they bring that broad-based stimulus that will fuel the whole of the economy? Number two, will it be successful? And I think I don't think it's absolutely certain that either of those two will get a positive answer in the short term. I think China is a little bit worried. But I think at the moment what we're seeing in China is the weakness is focused on the manufacturing sector. And China's much more focused on the services sector and on the consumer demand. And consumer demand still, fairly strong in China at the moment.
Eddie, thank you so much for joining this morning. Always a pleasure to speak with you. That is Bloomberg's Eddie Vanderwall. And for more market analysis from Eddie and the team, MLiveGo is where you want to head on your terminal. This is Bloomberg.
Traders again. I am going to place order to sell short United States against Japanese yen. Okay, I'm open new contract basically because we hold quite a few positions on on the contract United States against Japanese yen. And new order I'm going to place 138.440. Okay. So if you trade Japanese yen with us, we hold short positions for all day traders who knows how CFD contracts works. We don't pay money, broker pays us money for holding overnight these positions because this is short position. If you would like to find more information, you need to contact us. There are plenty of information on our website. Anyway, the order placed, and if it will reach the level 138.440, we'll open new contract, short position on Japanese yen. Okay, guys, stay safe. I'll speak to you later.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. Now, some of the top corporate stories we're watching. Carlyle and TrueStar are said to be seeking a partial exit from McDonald's China in a deal that would raise $4 billion. GIC and Mubadala, the Abu Dhabi Sovereign Wealth Fund, have been approached about the deal that values the entire business at up to $10 billion, including debt. A lot of different thread here, Kriti, to dissect. One of them, look, it has been this trend of American firms trying maybe not to be so closely tied to China, or at least exit part of their holdings in the region.
Yeah, let's put some numbers on it here. I mean, a record year in 2021, and we kind of knew that post their COVID policy. The value of exits in Asia, in the Asia-Pacific region, has plunged 33%. It's only at about $132 billion as of last year. So it seems like a big number, but relative to what it was, it is declining.
Yeah, and look, another thread that we're following is what's happening in the agricultural commodities sector. India, which is the world's biggest rice shipper, is considering a ban of exporting most varieties of rice because of rising domestic prices, and authorities want to avoid the risk of more inflation. Now, this move may already send lofty global prices even higher with the disruptive El Nino weather pattern returns. Kriti, I'm like, inflation, okay, I can stomach it, but not my rice. Please don't make my rice more expensive.
Well, this is important because India, of course, is one of the major exporters, and this idea of protectionism in an era where food prices...
Okay, traders, position open on Japanese yen, as you can see right here, 138.40, 400, right? So if you want to follow my trades, please do so. Otherwise, if you want to do your own research to find the right stocks for you or currencies, you need to get a strategy. We provide webinar. We teach people also when I have free time how we trade, how we make profit. And if you'll go to our company website, you can find all the information. And then after getting strategy, you can get an idea and whole information you need in order to make profit or to get a new job as a day trader. Okay, guys. Anyway, position open on Japanese yen. I'll speak to you later, guys.
In billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run. Surveillance Early Edition, here's what you need to know. Inflation ripples, markets going risk-on as the slowdown in U.S. CPI bolsters bets that the Federal Reserve is close to the end of its hiking cycle. The IEA says global oil demand won't grow as fast as previously expected this year as developed economies falter. And Disney extends the contract of CEO Bob Iger for another 2 years, giving him more time to implement his turnaround and find a successor. I'm Kriti Gupta in New York with Danny Berger in London. Look, Danny, I feel like the hot day to watch on the eco front was yesterday, although a lot of eyes on PPI today as well.
Yeah, and jobless claims, right? Is it still going to be really strong? Is this still a hot labor market? Is this immaculate disinflation in the works? At least here in Europe, we're still trading on that theme. Nothing to interrupt what happened yesterday. We're continuing to buy equities in Europe. The European stock 600 is up about 0.6%. I did want to flag one story. BASF, the chemicals company, cutting its production forecast, not production, I should say, cutting its forecast in general for demand late yesterday. So we're seeing it underperform. Most things are rallying, hence it's only down about 0.05%, but still it's troubling for Europe, for chemicals, for production, for kind of everything. We also got European industrial production data just about 30 minutes ago. That also came in weaker than expected. But elsewhere, yeah, it's this continued disinflation trade. Schatz are getting bought. German 2-year yield, those are down 7 basis points. And meanwhile, it's basically sell the dollar against everything. Sterling is stronger by about 0.5% versus the dollar. We're back at 130 for the first time, Kriti, since April of last year.
Yeah, the dollar weakness is really interesting because it is having ripple effects stateside as well. Take a look at futures, for example, 45.23 on those contracts, stronger by about 0.4%. Now, the idea of the inverse correlation between the dollar and the S&P 500 is starting to seep back into the narrative as we kind of see this fresh wall of cash, not from people within the U.S., but from around the world, perhaps entering this next leg of the year. What's interesting is that the pullback in the dollar is really coming from the bond market story stateside. Take a look at the 2-year yield here, already at about 5:30 a.m. in the morning, New York time, down about 10 basis points, 464 on that 2-year yield. Again, bringing back the concept that maybe the Fed is about to end its tightening cycle. That doesn't necessarily mean they're going to be cutting, though, and I think that's an important distinction to make. The 10-year yield, of course, at 382, following that lead, although I have to say, pairing some of the earlier move that you saw, it was down almost 5 basis points earlier in the session, now down, we'll call it about 3. I think a big question, though, is not just the inflationary story, but it's the recessionary story as well. And if Brent crude is going to be kind of our proxy for gauging how close we are to that, no signs here yet. 80 handle, Danny, on that commodity.
Let's talk more about the CPI numbers, Critty. And Senator Elizabeth Warren is calling on the Fed to halt interest rate hikes as U.S. inflation slides to more than 2-year low.
We have great news today that inflation has been cut by 2/3. So my message is take yes for an answer, Chair Powell, and let's stop with the rate increases. Done.
Done. Is it done? Let's get over now to Skylar Montgomery-Koenig, Senior Global Macro Strategist at TS Lombard. Skylar, is it one more and done for the Fed?
Yeah, I mean, we've definitely transitioned to the phase of the tightening cycle where the Fed is attempting to be gradual. They're trying to assess the impact of tightening and what they've already done. And we all know that monetary policy works with a lag, but no one, the Fed included, knows how long that lag is. And I think what we've seen is that the U.S. economy is much more resilient to a higher policy rate than we expected. At the same time, the U.S. has made this remarkable progress on inflation. The latest print is certainly a sign of that, but we've seen 4 months of negative inflation surprises. This has clearly been the trend for a while. And in response to that, the market's essentially priced higher for longer. And that seems to me like the least likely outcome. I think either we get a rise in unemployment and rates will go lower very quickly. The Fed tends to hike quite aggressively cut quite aggressively when they do cut. So in that situation, you'd expect rates to go down to 3%. Or the economy remains resilient, there's a risk of a reacceleration of inflation, and then the Fed is forced much higher. I think it's much more likely that we get a recession because policy is now restrictive, and that restrictive policy is destroying demand. So I think from here, we're definitely going to get a hike at the July meeting. It could be the last hike, but from there, you're really, really watching the unemployment data to see what happens.
I mean, Skylar, I'm just looking at this market really picking up steam when it comes to this Treasury trade 2-year. You can see it on the screen in front of you. Now up some 10 basis points when it comes to the down rather 10 basis points. Wow, if I can find my words, when it comes to the front end of the curve. How much further does this have to come in if this is the trade, if the disinflation trend continues? And as you say, we might even get a recession.
Yeah, I mean, it's actually interesting. We're moving very much on the inflation trade, but in terms of fixed income markets, the fixed income market moved on from inflation last autumn. And since then, reals have very much been in the driving seat. And that's put increasing attention on growth. And so the most recent spate of positive economic surprises we've seen, that put upward pressure on yields until we got the inflation print. But the problem is that as you get positive economic surprises, consensus revises up their estimates for growth. And that makes it harder to beat once again. And at the same time, the rise in real yields, that squeezes the economy even more. The higher you stay high, the more it squeezes. That restrictive policy, that destroys demand. So the higher you go in terminal, there's kind of this terminal tipping point that we talk about, where the higher you go, the more growth slows and the more cuts you need later on. And I think, right now these are counteracting forces on the long end, where growth is capping your yield, but the policy stance puts a floor until we get cuts. And so, now we're very much seeing downside momentum in yields, but there is only so low you can go until you get cuts, at least priced into the curve, if not imminently.
Skylar, when we look at kind of what's driving a lot of this economic data, it feels like a lot of folks are breathing a sigh of relief, as Danny pointed out, that risk rally that you're seeing. What is the most concerning piece of the inflationary data right now? It feels like we went from commodities to housing to wages at one point. Where's the concern now?
It's interesting because we're seeing a broad-based move in inflation coming down in terms of, yes, we always knew that the easy part of inflation would come off in terms of, we always knew that energy prices would be a drag at this point. We knew that that would feed into other components, and that, you know, was very evident early on in the data. What we're seeing now is actually core improving as well. And so I think those are creating this kind of disinflation mirage that will allow the Fed to cut when we get unemployment rising. The problem is what happens after that. In terms of, I think policy will have to be reactive to the fact that inflation in the coming cycle, so in the post-COVID cycle, will be higher than what we're used to. And I think that's a combination of you know, kind of the debt, demographics, and deglobalization that we've talked about sustainably in terms of, you know, those are all indicating inflation averaging around 3% in the coming cycle rather than below 2%, which is what we're used to.
So Skylar, then focus to us on kind of the lag here. Torsten Slok over at Apollo Global Management had made the point that the one thing that the markets are missing here is the 12 to 18 month lag that traditionally follows. So if you're worried about employment, for example, that effect is not going to show up until, say, 18 months after the Fed is done tightening. My question to you is, does the lag still matter, or is the lag still even that long?
I think, you know, the lag definitely matters in terms of we've had aggressive tightening very quickly. And so you're definitely seeing some of that tightening feed in. Policy rates are restrictive and that real rates have gone positive, and they've been positive for quite a while. And the longer you have positive real rates, that more that feeds into the economy. And so the longer you go from your first hike and you let those hikes that have accumulated feed into the economy, the more of an impact that has. And that's why, you know, even in a soft landing scenario, and even according to the Fed dots in 2024 and 2025, you get cuts eventually. Because what happens is, as you have inflation come down back to target, if your nominal rate stays where it is, real rates increasingly rise mechanically. And so that tells you that, you know, no matter what, there is somewhat of a lag, and that feeds in eventually. And so I think, you know, you just get this increasing squeeze, and whether that's shorter or longer, you know, we'll see that come out in the data. But right now, there has been more resilience than was expected. And so you'd think quite a lot of that still needs to feed in.
Skylar, how sustainable is a dollar downtrend? And if it is sustainable, against what currency would you want to bet that the dollar is going to fall the most?
I think right now it's really hard because there are a huge number of cross currents, and especially when you consider the major cross, which is euro dollar. So the balls can point to two scenarios for the economy. So the bulls would either go, you know, there's a hard landing that would create a safe haven bid for the dollar, or U.S. growth resilience, meaning the Fed has to do more than what's priced in. And that's been characterized kind of as a no landing scenario. I think the bulls can also point to the very high carry you get, as well as a faltering Chinese recovery. But, you know, the most compelling argument is that this rebound in economic surprises, especially when compared to the drop in European economic surprises, you know, that very much points to dollar upside. The problem is the bears have a bit more ammunition in that the view is largely dependent on a mild U.S. recession and moderating inflation, allowing the Fed to cut rates. And that's what we're getting come through now. And I think the biggest point is what we saw yesterday was that U.S. has made significant progress on inflation. There's also a significant overvaluation to the dollar and a slow shift away from kind of this dollar dominance. You're also seeing balance of payment trends move away, and this risk asset resilience is also more positive. Yeah. And I think, you know, that compelling argument, it's winning out right now. The problem is things are getting a little bit more hard on the other side in terms of Europe is looking increasingly weak. And as you approach key supports in TXY of 100, I think you'll need much more momentum to break that.
Skylar Montgomery Koning of TS Lombard, thank you as always for walking us through the eco story. And sticking with the inflationary theme that she was just talking about, we're going to talk about another aspect coming up on the show. A bad apple. The company is accused of bad faith negotiations during U.S. retail contract talks. It's just the latest in a slew of labor negotiations across the country. More on that next. This is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
UPS negotiation as a bellwether for all the other strikes that could be on the horizon, which the issues are strikingly similar. It's about workers feeling taken for granted, having sacrificed through a pandemic, workers feeling disrespected, knowing that they have sacrificed for these companies, and yet in an era of record profits that these companies can't find just a little bit more to take care of the people who are making them successful.
That was Liz Schuler, president of AFL-CIO, the largest federation of unions in the United States, speaking on Wall Street Week. You can catch that full conversation 6 p.m. New York time on Friday. Look, she hits a crucial point on those potential looming labor strikes, companies failing to meet workers' demands. You're seeing it in UPS, the automakers, Apple, the LA port negotiations. It just gets bigger and bigger. Let's get a little bit more insight from a true expert. Bloomberg Industry Group labor reporter Ian Colgren joins us now from Washington. Ian, the UPS Teamsters negotiations seem to have really changed the game in terms of how unions across the country, across sectors, negotiate at a time that they need to keep up with inflation.
Yes, it's true. Everyone is really looking at the Teamsters negotiation with UPS as a test of how much organized labor can get in this economy, especially with lowering inflation and things calming down somewhat from the pandemic, but workers still being discontent. The Teamsters sources I've been talking to as of last night told me that the talks are still broken down completely. There has not been any contact with UPS. They are waiting for UPS to call them.
I mean, not exactly a massive vote of confidence in terms of finding some sort of common ground. Ian, before we get into the nitty-gritty of some of the other kind of union conversations that are happening across the board, I want to play devil's advocate here. We've been covering the inflationary story heavily on this show, CPI now at about 3% year over year. As inflation comes down slowly, although ultimately coming down, how much weight or how much does that give kind of the corporate side to these unions who are saying our wages need to keep up with inflation?
You raise a really good point. As inflation falls, it becomes an increasingly harder argument for unions to make that they need more money to keep up with the cost of living. However, in this case, because inflation has just fallen recently, the argument from the union side is that the wages never really kept up with the inflation from the past year, from the past couple of years since the pandemic, and it's something that a gap that they are trying to close.
I mean, there's a lot, right, Ian, of different companies in the middle of union negotiations. Taking a step back, how do you look at the potential success of these talks right now? A lot of them seem to be coming up against roadblocks. How effective have unions been in the past year of getting their members higher wages?
Well, if you look at some of the big labor actions since the pandemic, one to look back to that turned out to really be a canary in the coal mine for the rest is John Deere. John Deere workers went on strike, rejected multiple contract offers from the company before coming back and getting a deal that they said was really positive for them, that eliminated a two-tier wage structure, very similar to what UPS, very similar to what the United Auto Workers are trying to do here. So there have been instances where unions have been successful. Other unions know that. They look very closely at this stuff. And they think, if they can do it, we can do it too. Whether they actually can is a different question because industries and the moving parts can be very different, but it's something that gains a lot of inertia.
Apple specifically, we have the store union there, their first unionized U.S. retail store in Maryland, accusing the company of bad faith negotiations. What do you make of what this Apple union has been saying this week, Ian?
Yes, well, this is something that the folks who have been a part of that union effort have really been bracing for since the beginning. The folks I've talked to who are involved in that union effort, the organizers with the International Association of Machinists, they never expected this to be an easy fight. They never expected Apple to fold instantly and give them what they want, right? Because this is something that is going to be repeated across ostensibly every Apple store in the country that unionizes from here on out. And so it's something that they know the company was going to be fighting. They knew the company was going to be fighting really hard, especially with how hard the company fought in Atlanta and some other stores that tried to unionize. And it's not a step that any union wants to take because it is an extremely protracted and messy process to file a complaint with the government this way that will probably not be resolved for quite some time. But I don't think it's a surprise to anybody that we got here.
Certainly something we're going to be keeping in mind with the larger story. Ian, let's talk about what kicks off today. Automakers are going to be kicking off conversations with the United Auto Workers in particular. And I feel like ordinarily when strikes come to focus, a lot of analysts and strategists say, okay, well, this is kind of an internal issue. It's not going to affect the earnings. Bank of America says something different. They're saying this could cost the automakers, GM, Ford, even Stellantis, billions of dollars. Walk us through those negotiations and what that means today.
Well, it is certainly possible that it could cost the companies a good chunk of change. And like we talked about earlier, these are not things that happen in a vacuum. A UAW source I spoke with last night told me that they are looking to the Teamsters negotiations as a roadmap for what they should do, the strategy they should take, and how they should get what they want. And both unions are really taking a militant approach to these talks, more militant than they have in the past. The United Auto Workers yesterday did not attend a traditional handshaking ceremony with the auto executives to start the negotiations, set things off in a good tone, in good faith, and instead they are taking the time to get their members ready and prepared for a strike, if that's what it takes. And this is a population of workers that has showed it's more than willing to strike. It went on strike for 6 weeks in 2019. It was the longest auto strike in U.S. history, and they say it's something they're prepared to do again if necessary.
Yeah, that contract ending, I believe, September 14th. Ian Colgren all over those conversations. Bloomberg Industry Group, we thank you, as always, for waking up early for us. Coming up on the show, a look at some of the market-moving events you want to watch throughout the day. We're going to walk you through it. This is Bloomberg.
let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Kriti Gupta in New York. I want to give us a quick look at what cable is doing. We are at the strongest levels of the morning. I'll show you that in just a moment. First, let me take you through the brief. We've got earnings before the bell from PepsiCo and Delta Airlines, 8:30 a.m. We're going to get U.S. PPI and jobless claims. Then in Helsinki, Biden is meeting with leaders at the U.S. Nordic Leaders Summit. He's going to be having a joint press conference with the Finnish president at 10:30 a.m. Eastern. Later, French President Emmanuel Macron hosts Indian PM Narendra Modi at dinner in Paris. Okay, let me show you the thing that I wanted to show you. That is sterling. Sterling at the moment above 130, Kriti. It's higher by about 0.6%. Really is that follow on through what we saw in the CPI report. There is a new report out about UK public finances on risky footing, according to the OBR, but this just goes to show a weaker dollar is overshadowing all of that.
Yeah, it's the trade that's really picking up steam. We know that the weaker dollar is weaker against all the major currencies, so certainly something we're going to be monitoring and keeping an eye. 131 almost on that cable rate. Pretty eye-watering if you are following that story. I want to go from the macro to the micro, Danny, and look at some of the stocks we're watching in pre-market trading here. Starting off with Disney, Bob Iger extending his contract. Now remember, in his first iteration of being CEO, he had extended his contract 4 times. It's something that's very well received by the market. Those shares higher by about 1.3%. And of course, Danny, we go from sort of media tech to definitely the tech space when it comes to some of the other stories I'm watching. Microsoft at the top of that list because the Microsoft Activision saga continues. Overnight, you now have the FTC led by Commissioner Lena Khan looking to appeal the FTC loss. They basically filed for an injunction against that $69 billion acquisition of Activision. That is a big mark in history. The FTC rarely ever appeals that decision. Looks like they are now. Microsoft shares higher by 0.7%. Activision Blizzard down by about 0.2. And lastly, Danny, you mentioned it, Delta, PepsiCo. We do have those earnings coming up, both in the green right now. And of course, the PepsiCo vice chairman joining the show later this afternoon. That's it for Early Edition. Surveillance is ahead. We've got Alan Ruskin of Deutsche Bank, Troy Gajewski of FS Investments, and of course, Torsten Slok of Apollo Global Investment. Tom, John, and Lisa will take you through the eco data ahead. This is Bloomberg.
they've been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Constantly underestimated the resilience of this economy. But we are seeing some moderation.
There is a long and variable lag to tightening of financial conditions into the real economy.
We're seeing disinflation everywhere. We're really seeing deceleration and disinflation in the U.S. economy.
We're seeing disinflation in the U.S. economy that is, gradually becoming more broad-based.
I don't think it changes the move in July from the Fed. They can't take their foot off the pedal yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Stocks up, yields lower. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your bond market has a beard. Yields are aggressively lower. Last week, on Thursday, 5.11% on a 2-year this morning. 464, a big turnaround, TK, following CPI yesterday morning.
I'm going to steal from Steve Englander. I know, John, you've got a comment from the wonderful cross-rate strategist from the Standard Chartered Bank, Game Changer. It's Game Changer Thursday, follows on from what we saw yesterday. And what I don't see is a lot of analysis of how yesterday's drama links up with tomorrow's jobs report. Jobs report scenario A, B, C. How does the disinflation report fold into that? That's the topic for today.
July done deal for a rate hike. Most people assume it is, Tom. Going forward from there, what does September bring? What does Jackson Hole bring? We need a few more data points like we did yesterday, Lisa, to get this Federal Reserve to change its tune, because listening to some of those Fed officials, that was just one data point for them.
And likely they are going to continue with hawkish rhetoric, even if underneath they're feeling pretty good. Even if underneath they're thinking, okay, this is the last one and we can go. But we got to tell them that we're going to necessarily go, because they want to get long end rates up just for that security that they can tighten financial conditions.
Going from the data to earnings season, TK, PepsiCo just dropped it across the screen. Full year organic revenue plus 10%. They had seen plus 8%. The estimate was plus 8%. So a lift to the outlook,
This
TK.
is the heart of the matter. Heart of the matter is perfectly timed as we begin what's going to be a really interesting Thursday. I'm going to go to Jackson Hole, the Pioneer Grill. We do our work. I go in, and you have to have the chipped beef on toast. And the cowboys are in there, like real cowboys are in there, and they're drinking Pepsi for breakfast with their chipped beef on toast. And that's how you get to 10% organic revenue growth.
Pepsi dovetails really nicely into what we'll see today with PPI, the Producer Price Index, coming out after CPI yesterday. It is likely going to come in lower than what the prices are that these companies can pay. Margins have been expanding slowly in a number of different companies because they have pricing power. How long can we see that? That, I think, is the silver lining that we keep seeing that maybe can narrow as we see headline CPI come in.
You know, Lisa, you and I put up with this. John is, you guys don't know this. John is so healthy, folks. Every day he can win the gauntlet in the food court and go buy the Cheez-Its without grabbing one. I have to. But John, Frito-Lay, and I know you're not familiar with any of their products, their revenue is up 14%. I've never imagined that in 30 years.
They do Quaker Oats, don't they? Over at PepsiCo. Isn't that their thing? I thought it was.
Sure about that.
No?
All I know
we can
is
double
that
check on that.
Tom single-handedly is boosting their profit margins.
Is that what you're doing?
Got that right.
Okay, good. Have we done with PepsiCo? I think we are.
That's a big deal.
Delta coming up a little bit later. The airline's up something like 50% year to date. Delta, United, American. Look out for those numbers later this morning. Equity futures right now on the S&P 500, positive 0.3%, adding to the gains from yesterday, adding to the losses in the FX market for the dollar. The euro pushing 112, 111.72, positive 0.4%, taking out the highs on that currency pair for the year so far. TK yields down. Dollar weaker. 11%
appreciation in the Bloomberg Dollar Index, and there's just a simple banner to put up on radio. I'll just talk it to you. USD MXN under 17 to a shocking 16.88. Again, on this Game Changer Thursday, John, I've never framed a sub-17 peso.
Getting closer to 112 on the euro, taking a look at EM and G10. Lisa, just to finish on the bond market, the 10-year at the moment, 381.
It has been a shocking move, particularly in the 2-year over the past couple of weeks. What we're looking at today, 8:30 a.m., U.S. Producer Price Index, as well as jobless claims. We are expecting the Producer Price Index to come in to 2.6% from 2.8% the prior month. The key is how long can it remain below what we see in the prices that companies can pay. Basically, our input prices that much lower than the pricing power that these companies have. And we get a read of that from the companies themselves. We just got Pepsi earnings. We're going to get a call later this morning around 8:15 a.m. Delta will come out around 6:30 a.m. and then has a 10 a.m. call. Very curious to see how long they can continue to pass along those price increases, particularly from Delta, after what we saw with airline prices going down 8.1% in yesterday's CPI report. And as far as Fed speak goes, 6:45 p.m., Fed Governor Chris Waller giving a speech in the Economic Outlook at a New York event. John, they're going to be hawkish. When do they start indicating that they're moving away from future rate hikes? Because right now, the messaging has to be consistent, that they haven't done enough, and that was what it has been consistent throughout all the speak yesterday.
Mike McKee's mentioned this a few times, but Governor Waller, this time last year, I believe, said that perhaps inflation could come down and unemployment could remain stable. He took a lot of criticism, Tom, from a lot of people in ivory towers in academia, and here we are. CPI coming down to about 3%, unemployment around 3.5%. I've got no idea what the future holds.
All these guys...
Just an observation about where we are right now.
All these guys are different, but Waller's hugely respected within the research community to synthesize those kind of data. And again, that dovetails with a Disinflation Wednesday and how do you link in tomorrow's jobs report and what it means particularly for the bears in this equity market.
Tony Dwyer with us around the table, Chief Market Strategist at Canaccord Genuity. Tony, wonderful to see you.
He hasn't been here since Nixon was
3 years.
Yeah,
I was wondering what happened to the Cheetos. And then I look over
They're
here
upstairs,
at this
aren't
guy.
they? Has he taken them all? Did you stock up this morning?
It's like the commercial all over your...
On the way out of the building, Tony, on the way out of the building, he takes some and takes them home with him.
Yeah, I do.
10 a day.
Well, they're free here. They're not outside.
I've got an intern, Tanya, from Northwestern, and Tanya, you look in her drawer, she's got a year's supply in there just to get her through it.
Tony, wonderful to see you. You've been cautious, conservative. Do you see reasons to be bullish now?
So, and I'm still that way. You're seeing a broadening out, which is healthy. But I thought yesterday was an interesting day because it, game changer. Listen, inflation should be going down. The economy is slowing. We've seen that in the forward-looking labor reports. The thing that's interesting is that the industrials and other cyclical areas underperform yesterday. The Dow Jones Industrials even was only up 0.25% after a really huge start. So
Dow Jones Industrial Average.
So, all right, so let's talk about back when they had candles that were on set because we didn't have lights when you and I got into the business. Right? Remember the Dow Jones Industrial Average? Every portfolio manager used it. That was the benchmark. But then it became so concentrated that the portfolio community made the S&P 500 the benchmark. It shifted in the late 1980s, early 1990s because of the concentration factor, and I think that's probably true here as well.
Well, just to build on what John was asking about, you have been defensive. Yesterday, a lot of people were saying it's a game changer. Jim Reed over at Deutsche Bank came out and said it's very hard to find anything negative, any negative spin on what we've just seen, which is real disinflation across almost every input. What would it take for you to change your view and become more constructive?
So, Lisa, our call's been to be light and tight. The time to be super negative from a market perspective. I'm negative from an economic perspective, but the time to be super negative from a market perspective was back last year, early in the year, as soon as Jerome Powell used the word Volcker. Because then you know who was going to intentionally invert the yield curve. When you've got so many companies that are they're still down 50% or 60% from their 52-week high, that's not the time to all of a sudden make a major downside bet. Light and tight means extra cash and a little bit more of a defensive posture to take advantage of a recession-based weakness. And I still believe that we're trending toward a recession because of the labor market. The employment trends index has never gone to the current level without being in a nearby recession. The same with even yesterday's small business hiring plans index. The optimism ticked up a little bit from a depressed level, but the hiring plans went down. So what would it take for me to change is really going to see the labor market inflect. In other words, you're stopping weakening from it. You're going to get this mystical soft landing despite I believe that the Fed is already probably 100 basis points too tight. So the idea that we should have expected, that we're going to keep going up in rates. Look at the disinflation in goods and non-durable goods. It's been extraordinary. How is that not going to happen for services if the labor market weakens? And that's what hits margins. People don't really, I'm kind of on a rant here. But
no, I didn't notice.
Well, I had too many Cheetos. So the margins come down and compress on a macro level when revenues fail. They can come down a little bit when costs go up. But if you look back at profit margins historically for companies, for the S&P 500 and for households, it's when you lose your revenue stream, you cannot cut your costs as fast as you drop the revenue.
You're an acclaimed optimist in the street. You've been cautious recently. I get that. I want you to walk through the process of how bears rationalize walking away from a bear call to some form of optimism in a bull. What's the process? Is it sector by sector? How do you move from being a bear to being, OMG, I got to be in the market?
So on June 7th, we had put out there's finally some hustle in the Russell. It's a broadening of the market. It's when you go from the mega cap tech stocks, remember the top 8 stocks earlier in late May represented 117% of the gain year to date. That's broadened out. Now it's about 70%. You're seeing it. But again, I think it has to be associated. That's associated with a soft landing scenario. There's so many indicators that don't prove that out, that what's really going to change them is ultimately you start to reaccelerate earnings or you go into a recession.
Earnings tomorrow morning. JP Morgan, Wells, Citi. What are you focused on, Tony?
Well, when I talk to the credit folks, the only areas that are really doing pretty well are the private credit. And what I might have gotten wrong, and early's wrong, I've been too defensive. What I didn't see as much as probably is happening is the impact of private credit. When you invert the yield curve, it stops banks lending. So I don't think we're going to hear anything tomorrow or going forward that all of a sudden the economy is really booming now and that banks are lending. The credit people I talk to, that's not accurate. What is happening is companies like Apollo and other names like that in the private credit market, PacWest, they sell $2 billion worth of bonds. If you sent that into the market, give me a bid, not good. But Apollo-led conglomerate just takes it all down on one trade. So there is something different in the credit market that may be buffering what would normally happen if you have a free, open market trading in public securities on it.
Tony, this was awesome. I can't believe it's been 3 years, which is just ridiculous.
I got to say, I love the show. You guys have a great vibe, and it's terrific.
Thanks, Tony.
I'm going to go up to the food court for a little bit.
That's all this praise is about. The free food upstairs.
Well, it took me 3 years to want it, but yeah.
Tony Dwyer there at Canaccord Genuity, going into the data a little bit later this morning, PPI, then onto the earnings tomorrow morning. Citi, Wells Fargo, JP Morgan, onto next week, Bank of America, Morgan Stanley, Tom, and Goldman.
Did you see my brain freeze there at the beginning of the show? I was up all night dealing with Seth Melanger and this great Red Sox thing we're doing, and I thought Jobs Day was tomorrow.
Oh, I thought you were talking about tomorrow as in like next month's jobs report. I
just tried to tune it out.
Like the news tomorrow. Tomorrow's news. Payrolls last week was yesterday.
I was waiting for you to gracefully put in there.
At least
like,
you just.
That's what.
I was giving him the benefit of the doubt. I thought he meant like tomorrow's payrolls report was next month.
That's normally what you would do. Is you would say like, we'll find out the hiring plans of the companies that are going to report earnings tomorrow.
Are you usually trying to smooth over the cracks? Like, sure, but I didn't realize that was an accident.
You should have just waited. Hey, stupid, it's not Jobs Day tomorrow.
Okay, well, you know it's not Jobs Day now. It's bank earnings tomorrow.
But bank earnings, I can fold into the disinflationary story, too. We'll make that script work as well.
Good save. How did the episode go on the Red Sox?
I'm humbled by the people I worked with, folks. This is, forget about, me and all that. This is about the Red Sox, the Penguins. And, John, a lot on Liverpool, much more on English football than I thought that Seth would do. But this is just this great team of people he had who said, oh, my God, he really sucks at this. We got to try to make this better. And I'm humbled. I'm really, we just heard from the Red Sox actually moments ago.
They're happy?
No, I'm not sure they're happy.
Okay, well, that's often a good thing.
I said to Julie,
you want to upset the subject just a little bit.
I said to Julie on Twitter yesterday, I said, Julie, pick up Ohtani from the Los Angeles Angels and make this good.
You have a plaque. Just upset the subject a little bit.
Just a little bit. Don't offend them so much they won't come back, but just a little bit. It can never be too happy.
Did Dwyer do okay?
Ever.
I thought Dwyer was...
If the PR's too happy, you've done something wrong. That's always been my take. Maybe that's the wrong take. Equities right now, positive. A third of 1%.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Earnings season is coming.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
You're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Great news today that inflation has been cut by 2/3. So my message is take yes for an answer, Chair Powell, and let's stop with the rate increases. Done.
Senator Warren of Massachusetts catching up with the team yesterday afternoon. on Bloomberg Politics. Balance of Power. Very good program. Should tune in later on in the afternoon, 5 p.m. Eastern Time. Senator Warren weighing in on the Federal Reserve. Guess what? Apparently they're not done. Morgan Stanley's Ellen Zentner, they're going to hike. That data yesterday won't stop them hiking in July. Mike Gapin, recent data keeps us confident the Fed will raise rates by 25 basis points in July. Andrew Hollenhorst saying the same thing. Maybe it changes the game for September. Andrew Hollenhorst, the city, has been saying for a while he thinks they go in July and again in September. This is what he had to say just yesterday. A July hike is still very likely. Softer CPI does raise the bar for a September hike, which could instead be pushed to November.
Oh, come on.
So that's the latest call right now, TK, on Wall Street.
Hey, Lisa, you're better at this than I am. You know, somebody said, what was the thing we had hawkish, what did we say like 10 days ago? Hawkish pause? What happened to that? I mean, we're just staggering.
Well, to be fair, they are going to hike potentially again this month.
Yeah, but we're staggering around on the data. The data yesterday was jaw-dropping. Forget about all the phrases and the dots. I like, John, what you said. The center tendency dot I'll give you. The dispersion of the dots is just a parlor game.
I take your point about the data, and this is the reason why a lot of people are saying by November, the data will have changed enough that they won't have the ammunition to hike, which is the reason why so many people think that the last one will be the one that we get on July 26th.
I don't know what to say. I'm looking at futures out there. They're beginning to test a 4,600 level.
Some good news for you. Oxford Economics, Tom, they agree with you. The tightening cycle likely coming to an end.
Yesterday, again, to Steve Engler, there was a game changer. There's also game changers in politics right now. We're going to stagger over to the July zeitgeist that's out there. Joining us, Vice Presidential candidate Terry Haynes. He's founder of Pangea Policy. Terry, Greg Vallier's causing trouble this morning, and he's bringing up what's always brought up, was a third party. I wrote back to Greg, I said the Manchin Haynes ticket looks awfully good, but it would also be third party pain. Are we really going to have a Ross Perot 2024 or John Anderson, a third party, to get in the way?
That's the current Washington parlor game. You're quite right, Tom. But I think the chances of that are very, very slim indeed. And particularly in making any sort of a dent. People always forget, even if they remember Ross Perot and his 92 run, that Perot got something like 19% of the popular vote, but didn't get a single electoral college vote, which is where the rubber meets the road on this stuff. There's a great deal of dissatisfaction with the two political parties, but at the same time, I think that said dissatisfaction is very much overstated. It's said a lot that, oh, there's 40% of independents and all the rest. You dig deeper and ask those independents which party they'd probably end up with or candidate. It's like 80 to 90% the place where they came from. So, and you can already see the beginnings of both political parties trying to light no labels on fire. So I think that's very definitely no.
Terry Haynes, I look at the bipartisan understanding that presidents love to go to foreign events, get a photo shoot, shake some hands, and then they have to come home. Who does President Biden want to have a photo shoot with when he gets back to the White House? What's topic one for the president after NATO glory?
Well, I think probably in the photo op category, probably Ambassador Markarova of Ukraine to the United States. After that, probably the EU ambassador and a few other folks from the European Union. The storyline here this week is, Biden's having a really good week between the inflation numbers and the NATO result. But I think that the real story in NATO, frankly, is Europe getting much more serious about common defense after all these years. You'll recall going back to the previous administration, Europe greeted with many constituent nations in the European Union greeted with some horror the idea that they were going to be actually asked to make good on their promises of 2% to GDP spent on defense. And, that we're way over the hump on that now. So, so Europe's rise as a more serious entity for its common defense, I think, was the big story there this week.
There were other reviews that came out, including this one former ambassador to Germany, John Kornblum, in the New York Times, who wrote about the communique from NATO, that it screams fear and insecurity from every word. Ukraine's future is with NATO, fine, but please don't ask when or how NATO entry will happen. Just make some unidentified reforms and we shall see. Do you disagree? Did you see unity and cohesion around the message, even if clouded in a lot of uncertainty?
Well, I think I did. They're all trying to shuffle together, right? And pay attention. I mean, this is not it's wrong to think of this as a United States-led coalition. This is a group that that needs to understand where they are in specifics and needs commonality of purpose. And they find it difficult to get there a lot of times, but they are getting there. And I think there was some mess and some cleanup needed, but fundamentally, I think that was around the edges. I mean, I think what you got out of this was a pretty good statement of purpose and a pretty good statement of where they are going forward. I mean, ask China and its client state Russia how they feel this morning. They're already huddling at the ASEAN meetings trying to figure that out this week.
Just quickly, in Congress, you are seeing discussion around some additional defense spending and possible social provisions put around said defense spending by a number of Republicans. Are you expecting this to be held up? Are you expecting this to become a real problem in Washington?
Defense spending? No, I don't think so. My view on the debt ceiling budget deal, starting the day after, was it really wasn't a budget deal in the sense of it being very binding at all. And what you were certainly going to get was increased defense spending. It's just a matter of how and when. Frankly, Washington will take the next 6 months to finalize that, and absent any emergency needs on the Ukrainian side in particular, I think what you end up with is a pretty orderly process on defense, just the way it always is.
Terry, I want to finish with the latest news in Washington, D.C., and it's concerning for this administration. Commerce Secretary Gina Raimondo, among U.S. officials whose emails were breached, hacked, Microsoft saying that hack originated from China, this reporting according to a person familiar with the matter. What's your response to that this morning, Terry, after we've seen Blinken go to China and Yellen go to China?
Well, spycraft is statecraft, I think. We're not going to stop spying on the Chinese or, for that matter, many of our allies. China's certainly not going to stop with us. Cyber warfare is a battlefield, and it will continue to be so. What I've always thought is that our structures, our infrastructure, whether it be in the e-world or in pipes and phone lines and the like, we've spent what amounts to a generation pretending those issues and problems aren't there, and we better hustle to actually bring our systems up to snuff. And that's certainly not the case in the federal government, but they really need to be working on that.
Terry, thank you, sir. Terry Haynes there of Pangea Policy. Just a little bit more colour on that story. Officials say the breach was relatively limited in scope, not just the United States, but reportedly, Tom, agencies in Western Europe also affected.
It's a whole new world. I mean, it's all there is to it. And I would like to believe, like a lot of people, John, that we have an entire infrastructure we don't know about that's doing something about this. But that's how you get in trouble. I mean, as Terry commented there, what's the initiative to maybe take the hyper secret and make it a little more visible?
The latest news this morning out of Washington. Coming up shortly, Adam Ruskin at Deutsche Bank. Take a look at what's developing in the FX market. The dollar a whole lot weaker off the back of yields, which are a whole lot lower in the last 24 hours. The euro against the dollar taking out highs for the year, 111.61 on the screen right now. A new high for the session, 111.74 just moments ago. Adam Ruskin at Deutsche Bank on why that can continue next.